The market wants to be positive.
This is a market that is ready to rip.
We are long the equity market. I'm comfortable with the way the market's behaving.
Heightened geopolitical risk, but also bullish markets. That is the prevailing mood right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, following a weekend of confusion, the US and Iran deadlocked, heading into this week's ceasefire deadline. Renewed tension through the Strait of Hormuz, sending oil prices higher and tapping the brakes on a stunning, record-breaking stock market run. Futures inching lower this morning.
Inching, the key word. And I think that that's a really important distinction, the idea that you see a 0.4% decline in futures after the best weekly gain on the S&P 500 going back to May of 2025. A question of just how much bad news this market is willing to shrug off. Yes, you're seeing a little bit of a retracement of what we saw on Friday, but in general, you are just so not seeing a significant response from bonds and from equities.
We do see the market moving on Friday. It was whipsaw, but the facts on the ground still this morning have not changed, and I would argue actually the tensions have gotten worse this weekend. We had the United States Navy fire upon and board an Iranian-flagged vessel. That have not happened since the start of this blockade. The IRGC says they're not allowing any vessels through. And then the ceasefire is going to end in 2 days. And at this moment, there's no confirmation, and I spoke to a Pakistani official earlier this morning, no confirmation just yet that the Iranians are showing up to Islamabad.
So let's talk about that deadline. That deadline is later on this week. What's more likely? An extension of the ceasefire or a resumption of hostilities? This market is leaning towards the former and not the latter.
They just expect there to be a resumption of hostilities. There still is a bit better than 60% chance, based into prediction markets, that this will all be tied up and you'll have an open Strait of Hormuz by the end of May, even though we are getting closer to a hot war. There was a great GIF online where it was saying, open, closed, with the Strait of Hormuz. And that's kind of how it feels. And the market is just tuning it out.
The market's just not pricing an extended shock. Deutsche Bank put out a brilliant piece on that earlier on this morning. This market, the equity market, is anchored to the outlook for earnings from a handful of the biggest companies on the planet, and that's really driven this relief rally over the last several weeks.
Especially technology stocks. And suddenly people are coming around to feel like, oh my goodness, things look cheap now, given the fact that there was a 13-day retracement. So we can pile back in, given all of the investment that keeps on coming. It's not just the big tech names, though. We've seen better earnings from banks. We've heard better earnings from even consumer discretionary. So at what point does that get torpedoed by some of what we see? And right now, people are saying it's a pretty high bar.
3 weeks of 3% plus gains in this equity market. Futures this morning down just 0.5%. Coming up this hour, we'll catch up with Cameron Dawson of NewEdge Wealth, with stocks pulling back from all-time highs. Norman Roule of CSIS as the US seizes an Iranian ship. And Francisco Blanch of Bank of America on why oil prices are priced to perfection. We begin this hour with our top story. A weekend of tension in the Middle East, casting doubt on planned peace talks. Our team coverage starts right now with Bloomberg's Tyler Kendall in Washington and Jemana Besechi over in Dubai. Jemana, let's start with you. Just what broke down over the weekend?
Oh, a lot went down, John. I would say from a lot of optimism on Friday that perhaps we were nearing the end of this war and a potential breakthrough on the Strait of Hormuz, a full reopening of the Strait of Hormuz, things have significantly deteriorated, and not least because the IRGC are claiming so long as the U.S. naval blockade is in place, they will continue to effectively monitor and control who has right of passage through the Strait of Hormuz. Saturday morning, there was reported gunfire, gunshots being directed at some vessels that attempted to pass through. Other vessels decided to make the U-turn, not make or risk going through the strait. And then, of course, this morning, CENTCOM announcing that they had seized an Iranian-linked vessel after giving them 6 hours warning, a notice to turn around, which they didn't listen to. So when it comes to the strait, I think it's fair to say that not only is it still effectively shut, but it is still very dangerous for vessels looking to cross. And why is this relevant? Because we have a clock ticking. There is a countdown to the end of the ceasefire. It expires on Tuesday evening, which is Wednesday over here in the region. And you will recall that one of the terms of the ceasefire was a free and unconditional opening of the strait. That has not happened. And so far, the Iranian side are not committing to attend these Islamabad negotiations. We know that the U.S. are planning on sending a delegation. And even though there are murmurs coming through from state TV over the weekend that there had been some progress of sorts throughout the course of the negotiations over the last couple of weeks, there still remains a lot of differences between the two sides. And then they've also contested, on their part, that many of the assertions that President Trump put forward over the weekend, including that they had agreed to a suspension of their nuclear program and a complete abandonment of enrichment, they have said are not terms that they have agreed to. So when it comes to the Strait, when it comes to nuclear ambitions, when it comes to the matter of proxies in the region, and then finally that question of lifting sanctions and unfreezing assets, there's still a lot of question marks. But at this point, we just don't know if the Iranians are going to attend those Islamabad talks that are set to start tomorrow.
Tyler, let's build on that. It's critical. What are the prospects for a diplomatic breakthrough ahead of that ceasefire deadline?
Well, John, the White House maintains that diplomacy is still a viable option at this point. White House telling us that we are expecting Vice President J.D. Vance alongside Special Envoy Steve Witkoff and the president's son-in-law Jared Kushner to depart for Islamabad later tonight. But as Jumana just outlined, Iran at this point is wavering on whether or not it will send diplomats to another round of these peace talks. And the escalation this weekend is only further threatening to derail the process. But still, after everything we saw, from the seizure of the tanker to Iran reimposing those restrictions in the Strait of Hormuz, President Trump still took to Truth Social and posted that he thinks that there is a path forward for progress. But he also reiterated importantly that the U.S. stands ready to target Iranian civilian infrastructure if a deal is not reached by tomorrow's deadline. We also heard from the Energy Secretary Christopher Wright, who reiterated that same message. But in an interview, John, over the weekend, he said that he does think that it is potential that we could see a breakthrough for a deal within the next few weeks. In his words, at this point, we're going to have to wait to see where this ultimately goes, because as we're discussing, we're also getting mixed signals from the other side. Iran's foreign minister at this point not committing to sending people. But we should point out, on Iranian state TV, we heard from the country's president indicating that they also don't want to see a resumption to the fighting.
Bloomberg's Tyler Kendall alongside Jumana Basenchi. Tyler, Jumana, thank you. Let's build on this. The view on Wall Street looks like this. Cameron Dawson of NewEdge Wealth writing, if you look through the narrative, the economic data, the breadth, there are plenty of things to like about this market. Cameron joins us now for more. Cameron, good morning.
Good morning.
That's a big question. What is there to like right now?
Yeah, I think it's two main things. One is leadership. There has been a very cyclical pro-risk on leadership that we've seen in this rally, which of course is encouraging. Things like equal weight discretionary versus staples outperforming, transports outperforming. You also like positioning. And we think that this has been the key reason why we've seen such a powerful rally. You went from being deeply underweight just a couple weeks ago to very rapidly back up to neutral. And that kind of buying power has really been the fuel for why we've seen markets move up so far so fast. I think some of that is now behind us, which means we're far more sensitive to incoming news, meaning we need good news in the Middle East in order for this to continue. But it certainly was a very powerful rally just because people got so very underweight back in the swoon in March.
It's hard to say we got good news over the weekend.
No.
We came into this week at all-time highs and a massive, powerful rally, and we're down just 0.4% on the S&P. What is the signal you take from the reaction this morning?
Yeah, it is very surprising that you're seeing such a muted reaction after you saw markets get so very overbought. So we think that there is still a lot of hope and optimism in this market, and based on the fact that you're still trading at 20 times forward earnings with 17% earnings growth priced in for this year. But I think it's important to note, so much of that earnings growth is coming from an incredibly small cohort of names. In the first quarter of this year, 50% of the earnings growth is coming from just two names, Micron and NVIDIA, which is absolutely incredible. And if you roll that forward to the entirety of 2026, an entire third of the earnings growth is coming from just those two names. So this is really a message about idiosyncratic growth coming from this market, not necessarily something that's much more broad-based.
And that's being reflected in the longest streak of gains for the NASDAQ going back to 1992. We're talking about 13 consecutive days. Do you think that that can last, given that a lot of the big tech names had not kept up even with this kind of trajectory for earnings growth?
So much of this rally lasting really depends on if valuations can get back up to their prior peaks. And I think you have to think about it in two major cohorts. The first one is the semiconductors. Semiconductors are very cyclical companies, meaning they trade with counter-cyclical multiples. You put the lowest multiple on the highest earnings. Earnings for the stocks are going to grow 100% this year. what's the right multiple to put on those earnings that are certainly going to slow in 2027? Then the question is with the Mag 7 names, which are such a large portion of the NASDAQ, you have there where you've seen a big deterioration in the free cash flow generation. Free cash flow for the last 2 years is down 30% for the Mag 7, while earnings are up 40%. So the question there is, are you really able to get back up to prior peak valuations for the Mag 7, given the fact that the quality of those earnings is so much worse than it was because of this CapEx?
It's refreshing to talk about this and not what if it gets open, what if it gets closed, which is essentially where people are at, and what does the central bank do? And ultimately, how much has the rally and the sort of relief that you've seen in markets get driven by the fact that central banks seem to have de-emphasized hiking in response to inflation coming from this conflict?
Falling bond market volatility is a really important driver of liquidity for markets. So the fact that you've seen the MOVE index come down as you've seen 10-year Treasury yields and 2-year Treasury yields moderate, given the fact that oil prices have moderated, have certainly been a boost for this market. I think at the end of the day, though, we are out of the era where we are getting good news cuts. We think that over the last 2 years, you've been in an environment where the Fed was able to cut rates because you were in a moderating inflation environment without having to see a concomitant deterioration in the employment side of things. But given the fact that inflation is likely to continue to run hotter than their target, it just suggests that the next rate cuts from the Fed likely have to come with sharper deterioration in the labor market, which just means that they're not as good news of cuts.
And what happens to consumer spending? Over the weekend, there was a poll, and about 2/3 of Americans are saying that higher gas prices have been a problem for them and their families. Does this mean there's going to be basically less spending for consumers have for discretionary goods?
If you look at the January and February real wage growth, it was nearly flat. And if you remove transfer payments, it was negative, which just suggests that there is absolutely zero room for consumers to be able to absorb higher prices. You also have a savings rate that's also very low, which just means that consumers are operating at a very razor-thin margin. So these higher oil prices are likely to weigh on spending. We get retail sales this week, and on the headline, they will look great because retail sales is a nominal number. But if you start stripping out autos and gas, it's likely for March that you're going to see more deterioration or much more of a slowdown, simply because of that razor-thin margin that consumers have with both real wage growth as well as savings.
Cameron, it's always good to catch up. Thanks for being here. Cameron Dawson there of NewEdge Wealth, looking ahead to retail sales a little bit later this week. Looking ahead to next week, we'll get some stunning earnings. Amazon, Microsoft, Meta and Alphabet all coming up next Wednesday.
Key question for me, and I'm sure it's for you as well, a question here about just going forward, how much they're going to keep spending.
In just a moment, we'll have more on the war in the Middle East, and we'll get you up to speed on Norman Roule's latest views from CSIS. Live from New York City, you're watching Bloomberg TV. Let's just take a beat and check out this market. What a run we've seen over the last month or so. A 13-day stretch of gains on the Nasdaq 100, the longest since 2013. Your equity market this morning down just 0.4% on the S&P 500, on the Nasdaq down by 0.4%, on the Russell down by 0.8%. All three closing at all-time highs going into the weekend. And it's not just about semis anymore. Software having one of the best weeks we've seen in quite a while. Microsoft with the biggest weekly gain we've seen in some 10 years. For Microsoft, all of that into earnings for those big players a week away.
Yeah, and people have been saying, well, it's just that the likes of Microsoft have been so beaten up that their profits clearly outstrip people's expectations. Earnings are going to be really important because do we get a sense of how much they're willing to keep spending, given the fact that you're getting investor pushback about some of the big CapEx plans? People are expecting an acceleration of spending into 2027. Can they do that if they aren't showing the same kind of earnings growth that they have in the past?
So the diplomatic effort on the brink of breaking down, and yet these are the moves. Equities down by just 0.4%. On the S&P. In the commodity market, a rally of 4 to 5% on WTI and Brent. WTI at $88 a barrel, Brent crude at around $94.50. Under surveillance this morning, taking a stand against Iran.
We'll be talking about Iran later. We have very good conversations going on. It's working out very well. They got a little cute, as they have been doing for 47 years. Nobody ever took them on. We took them on. They wanted to close up the strait again, as they've been doing for years. And they can't blackmail us. We're taking a tough stand. They've gotten away with murder for 47 years. They're not getting away with it anymore.
So here's the latest this morning. Tehran vowing to respond after the US seized an Iranian ship near the Strait of Hormuz. Roule of CSIS writing neither side wants a full regional war this week, but neither is prepared to offer concessions that would allow the other to emerge as the clear victor in this struggle over the strait. Norman joins us now for more. Norman, welcome to the programme. That ceasefire deadline days away. In your opinion, and for you yourself right now, what are you focused on as we approach that deadline?
Well, although the Iranians have not yet confirmed that they will attend this evening, the fact that Vice President Vance and Jared Kushner and Steve Witkoff are still planning on attending indicates that the United States must have pretty good reason to believe that the talks will take place. That's no small thing. So the indications are that there will be talks. The United States must believe that the talks will be fruitful, or they would not have put in such a significant effort. This said, the last 72 hours have produced such a series of significant events in the region that it shows that the Strait of Hormuz itself will remain the focal point for not only the talks, but it is now part of the negotiations themselves. The Strait of Hormuz and actions there are pressure points for each side to use against the other.
Norm, is China putting pressure on Iran to open the strait?
No country actually has a significant capability to influence Iran's decision-making. However, Iran does use China or Pakistan or sometimes Russia as a doorway to go into negotiations. For example, recall that China was a guarantor of the Saudi-Iran security agreement. That didn't work out very well, now did it? And China, in theory, could have pressured Iran to end this conflict some time ago. That hasn't happened. But in theory, China could be a doorway that Iran could use to enter into negotiations or shift its policies. And Iran might do that because it would see that as undercutting U.S. influence globally.
Norm, depending on what kind of Iran shows up to Tuesday, if they do show up to these talks, it's almost as if who's driving the narrative. You have the political figures like the foreign minister putting out tweets on Friday that he believes the strait should be open, and then clearly a different posture from the IRGC. Who should we be paying attention to?
Well, let's take a look at that for a moment. Now, the foreign minister has no political base whatsoever. He is close to the Revolutionary Guard, and he would certainly not take any position to talks unless it had been approved by the Supreme Council for National Security, which is dominated by former Revolutionary Guard members and has always been taking positions that have been based on a consensus. So there is likely a situation where we've watched Iran undertake a situation over the weekend where they have, in essence, laid out a series of activities which have been meant to show they have a capability to open the strait if they wish. They can close it. They can use it as a pressure tool. But we shouldn't take Foreign Minister Arakchi as a power player in this world. Now, we should look at this Palibaf, who also is likely to show at the talk, as giving a speech this week in which he communicated to hardliners and the hardliner base saying, look, talks are just one more tool that we're using to push back as a deterrent against the West and the Americans. But he highlighted in the talks, we don't trust them, and we're doing this to obtain sanctions relief.
Norman, how can the U.S. negotiate with Iran if we don't have a sense of who holds the power in Iran?
I think we have a pretty good sense of who holds the power in Iran. It's a consensus view of hardliners who are generally sharing the same fabric of decision-making, and no one would show up to those talks unless they have a common position. But that doesn't mean the common position is going to be a position that is going to produce an agreement. Recall that when the talks took place with the original nuclear agreement in 2015, those talks also involved discussions in Tehran in which there were a variety of positions as hardliners and more pragmatic conservatives, as they were called, debated whether or not there should be an agreement. Indeed, that debate took place up until the very end of the talks, indeed into the last hours of the talks, as to whether or not that agreement was something that was in Iran's interest. So this is not something that is unusual in Iranian politics.
Norm, there's also a question, and Annmarie was alluding to this, about the power dynamics in the region. The U.S. has been hugely important in the region, has had a huge base there. I'm just wondering whether you see any of the influence shifting as Saudi Arabia has meetings and talks with Xi Jinping, when you see the UAE also following suit and talking about their relationship and considering maybe even tightening it going forward.
Well, the relationship with China has always been powerful on a commercial basis. We've seen China be the #1 trading partner with the region since about 2014. That's not going to change. However, we've also seen the United Arab Emirates and Saudi Arabia reinforce in recent weeks that their primary partner for strategic investments will remain the United States. And we've seen that this comes down to technology, this comes down to economic agreements. I think you should look at the Chinese commercial agreements with the United Arab Emirates and Saudi Arabia more as an example of these countries telling Iran, look, we have a better relationship with these countries and a more important relationship than you'll ever have. Don't think that we don't know it. And we're going to tell the world that this is the case as well.
Norm, then what do you make of the Wall Street Journal report about Emirati officials telling the United States that if the UAE runs short of dollars, they're going to look elsewhere, maybe to Beijing?
I'm sorry, could you repeat the question, please?
There was a Wall Street Journal report about how Emirati officials, when they were there for the IMF World Bank meetings, told the United States that they may need help in terms of a swap line. If they can't get U.S. dollars and they run low on U.S. dollars, they may look elsewhere for support, like to Beijing. What's your reaction to that?
Well, I'm not sure that's entirely the case. I think what we're looking at is that we're looking at stresses on the regional economy that go beyond the oil issue. We're looking at stresses that are becoming a financial stress as well. But we're seeing also that the United Arab Emirates has come to the United States. Its currency is pegged to the dollar. It's been a very stable currency for decades. And I think you're going to see that as a result of these talks that took place last week, that this relationship becomes even tighter. And the United States will look to the United Arab Emirates to, in essence, maintain that relationship in a deeper fashion. But two things will come from this. I think you'll see the United States say to the Emirates, how do we build this relationship in terms of banking supervision regarding Iran? But at the same time, the Emirates will come to the United States and say, how soon are we going to end this conflict and open up the Strait of Hormuz? What does this mean? But I think you should look at the currency swap report in the Wall Street Journal as an indication that the United States and the region as a whole are going to stay close and are getting closer. My engagement with regional officials has reaffirmed this in recent weeks.
Hey, Norm, it's always good to get your reaction and your educated response on things. Thank you, sir. Norman Roule there of CSIS. I have to say, from my standpoint, seeing that report, it sounded less like a country in distress and more like a country offering a loyalty test to a key partner.
1,000%. This idea of saying, are you going to back us, given the fact that reports have the UAE has plenty of cash. It's not as though they're actually running out of cash. Saying, are you willing to be our financial friend? And if you're not, we'll go to check to raise some renminbi. And that, I think, was sort of a warning shot at a time where they would like to see this end. And they would like to understand exactly how much leverage they have, given that their economy has arguably been affected the most.
If you are just joining us, welcome to the programme. Headlines crossing the Bloomberg just moments ago that the Chinese leader held talks with the Saudi Crown Prince, according to a media report. The Chinese leader saying normal passage through the Strait of Hormuz should be maintained. China advocating for immediate comprehensive ceasefire, insisting on resolving disputes through diplomatic means. And we'll see if that diplomatic engagement continues going into that ceasefire deadline over the next few days. Coming up on the programme, we'll catch up with Francisco Blanch of Bank of America on why oil markets are priced to perfection. Plus, Yahira drops by with your morning movers. Marvell shares rising on reports of a partnership with Google. That stock is up at a pre-market by 7.4%. From New York City this morning, good morning. You're watching Bloomberg TV. 5-day winning streak on the S&P, 13-day winning stretch on the Nasdaq 100. Phenomenal. Equity futures down this morning by just 0.4% on the S&P. On the Nasdaq down by 0.4 also. On the S&P, this data from the team here at Bloomberg, more than half of the S&P 500's recent advance coming from just 7 companies. Nvidia, Amazon, Microsoft, Broadcom, Alphabet, Meta and Apple taken together, adding roughly $4 trillion in market value in the matter of weeks.
So is concentration anxiety a good thing, a positive feature, or is it a bug? And ultimately, increasingly, people come on the show say it's a feature because these companies had gotten beaten up before and they're actually just having a recovery trade given their huge profitability. The earnings are going to be the tell, and you keep pointing to it. Next week, a key point when they come out and give a sense of what their cash flow is like ahead, as well as what their expenditure plans.
To make how comfortable this market is with risk right now. Risk specifically coming out of the Middle East. Crude with a bounce, but not a material bounce. 4 to 5%, that's nothing, given the volatility we've seen over the last 2 months or so. Brent crude this morning at 94.51. WTI at 88.39, higher by a little more than 5%.
It's so amazing to see WTI crude below $90 a barrel right now. This is important for this administration. You can see how concerned consumers are when you look at some of the polling that's being done about the president, the handling of the war, and also their concern about inflation and gasoline prices. At the same time, when nothing is changing when it comes to the Strait of Hormuz, and I would really argue that this weekend, actually, we saw a lot more kinetic confrontation between Iranian vessels and the United States of America.
You know what's got a bit snoozy? The bond market, 2s, 10s and 30s. Let's go with 10s. 10-year bond yields over the previous 3 weeks just edging lower. The 2-year just anchored around 370 to 380, which is basically where Fed funds is right now. This Fed won't be hiking anytime soon, not in a rush to cut either. And that seems to be the story going into the summer.
Yeah, Chris Waller, the Fed governor, on Friday put out a speech where he started to talk about how high the bar was for him to cut interest rates again, given the inflationary push from this recent oil price shock. To your point, not cutting rates, which perhaps is what's anchoring the 10-year Treasury yield. People aren't worried about runaway inflation. The credibility of the Fed right now, based on markets, appears to be intact.
The 10-year at 4.26. Let's get you some signal names, some morning movers. With more, Yahira joins us now. Hey, Yahira.
Hi, John. That bounce in oil prices you were just discussing is lifting the U.S. energy sector, with names like Exxon up 1.4% as tensions with Iran escalate. The U.S. seizing that Iranian vessel over the weekend and Iran threatening to retaliate are dashing hopes for peace talks as both sides seem at odds over those talks in Islamabad. And a clear casualty of this escalation are the travel stocks, the airline stocks, with names like United down 1.7% in the pre-market as jet fuel costs remain elevated. And this is an industry already in damage control mode. They've had to cut capacity and even entire routes. And the worry now is that this could drag on and hit to demand and profitability during the crucial summer travel season. And we end on shares of Marvell Technology. They are rising nearly 8% now in the pre-market on a report that it is teaming up with Google on new AI chips. This is really about Google challenging NVIDIA's dominance as Google doubles down on its own in-house chips and tries to reduce reliance on NVIDIA's GPUs. And Marvell, as a designer and producer of chips, could clearly benefit from that. John?
Yahira, thank you. Thanks for the update. More from Yahira later this hour. On our radar this morning, traffic through the Strait of Hormuz remaining at a standstill following the U.S. seizure of an Iranian cargo ship. The escalation casting doubt on whether the two nations will meet for peace talks tomorrow. Elsewhere, the president renewing threats to attack civilian infrastructure in Iran. In a Truth Social post, the president vowing to, quote, knock out every single power plant and every single bridge if Tehran does not accept the U.S. deal. And finally, U.S. Energy Secretary Chris Wright saying gas prices may not dip below $3 until next year.
I don't know. That could happen later this year. That might not happen until next year. But prices have likely peaked, and they'll start going down. Certainly with a resolution of this conflict, you'll see prices go down. Prices across the board on energy prices will go down.
The national average for a gallon of gasoline remaining above $4, the highest price since August 22.
Yeah, and people pointed to the fact that Treasury Secretary Scott Bessent had said previously that the price of gasoline was likely to go down to that 3% level or even below by the summer. This is a political issue, and this is an issue of a calendar going into the midterm elections. And how much can this administration really fortify some of the support that they've seen in polls recently based on the ceasefire? Can they get oil prices down to 3%? We ask every single commodity strategist who comes on, and they just either say no comment or they just say no. And that ultimately is what a lot of people, at least in markets, seem to believe.
$3 a gallon is going to be really tough for this administration. It's not just what's going on in the Middle East and the Strait of Hormuz, but also it's peak driving season, where naturally and normally with the cyclical cycle of energy prices, you do see prices rise in the summer. So this is going to be a really hard time that they're trying to go to before the midterm elections. And once again, I mentioned this poll over the weekend, 2/3 of Americans are saying gasoline prices themselves are putting a lot of pressure on them and their families right now.
It's certainly a problem for confidence. Crude rising once again this morning, following a weekend of tension in the Middle East, culminating with the U.S. seizing an Iranian ship. Francisco Blanch of Bank of America writing the paper oil market is priced to perfection that ignores post-conflict energy economy realities. Francisco joins us now for more. Francisco, thanks for making time for us this morning. That line at the end there, the post-conflict energy economic realities, what are they that you don't think we quite appreciate?
Hey, John, great to see you again. Look, I think there is, number one, potentially a fair amount of refinery damage. Remember, about a third of the traffic in oil markets through Hormuz is roughly a petroleum product. So we're going to have a hard time restoring petroleum product flows, which means, you were talking about gasoline earlier. And I do think that, gasoline is probably the least important product out of those being exported through Hormuz. Only 5% of seaborne gasoline globally flows through Hormuz, but there is other products like jet fuel or diesel, naphtha that are much more reliant on that strait for supplies. Number two, there's also oil fields. There's many old oil fields in the Middle East that have had to be shut down in order to essentially contain the storage overflow. And that could be also a problem as we restart those. There's potentially pipeline damage. And then, of course, there is just unknotting the web of vessels, which are tied up on both sides of the strait and need to be essentially reshuffled in a very meaningful way to restore flow. So I do think those are probably the biggest constraints on the oil side. And then on gas, there's a few others, as we know, because of the Iranian strike in Ras Laffan about 3 weeks ago.
Francisco, can we just sit on one product then, jet fuel? And can we talk about cushions that are available to some regions? How big is the cushion of available jet fuel in a place like Europe? I imagine it differs across from one country and one nation to the next. But in your opinion, for the region as a whole right now, how big is the cushion that they've got?
Well, we heard it from Fatih Birol last week. It was 6 weeks, so I guess now it's 5 weeks, which is why time is of the essence to restore flows and to restore refinery operations across the entire Middle East. Which frankly, counts on two countries, Iran and Saudi Arabia, have two of the largest global refining toolkits. So we need to see all those flows being restored. But yeah, I would say Europe probably about 5 weeks at this point. And John, we are already seeing cancellations of flights. It's relatively small at the moment, but it's going to start growing into the summer, because one of the challenges here is that we are going to peak demand season in the next 5 or 6 weeks. And once we get into June, it's going to be complicated. So it's not just about locking in your fare, locking in your flight, is that flight just might be canceled.
Francisco, is this just a European issue, or when you have certain regions that no longer have availability of jet fuel, does that torpedo a lot of international travel more broadly?
Well, it does, because remember, the only product globally that has the same specifications across the oil complex is actually jet fuel, for the obvious reasons that the Boeings and Airbuses that fly around the world have to be filled with the exact same specifications. So there is that challenge. You might be able to fly out of North America, which is sitting long product, generally on long crude oil, but can you get back? I don't know. And I think the other issue that's important to think about here when it comes to the petroleum product complex is that perhaps you were talking all about gasoline, but gasoline, there's some flexibility there. We could see more butane blending into summer gasoline, which would shave off some of the prices. You could see the relaxation of other fuel specifications into the summer. And then also, again, Gasoline, it's a lot harder to make under summer spec, but then winter spec is generally easier to meet and demand tends to be lower. So I am perhaps a little more bearish on gasoline relative to other products. Once we pass the summer, I do think it's easier to get gasoline lower relative to other petroleum products.
Francisco, a lot of people have commented that they take some comfort in the back end of the curve for oil prices. You do have this unprecedented backwardation, that the front end, that current prices incredibly high, and you see at the long end, or just in December, you see about $80 a barrel when you look at Brent crude. You think it's the opposite. You think that's a warning sign. Why?
Well, we do think that the conflict, first of all, is still far from over, as we've seen over the weekend. Only about 20 vessels passed through on Saturday, and frankly, we need to see what the final negotiations yield. We know it took about 20 months to negotiate the JCPOA. This negotiations can be complex. And I realize that all parties want to get to a quick resolution here, but this takes time, and we need to see the flows occurring in the meantime. If they're not, the flows are not moving, that's a big problem for the market. But also importantly, we do think that, as I pointed out earlier, there's a lot of potential facilities that may not be able to come back in full force. Even if we get back to 85% in the next 2-3 months, we're still going to need another 6+ months to get to the last 10-15% of oil flowing through Hormuz. That's 2 to 3 million barrels a day that the market will be short into the end of the year. So, while we are, we're hoping that there's a resolution soon, we will still likely miss a fair amount of energy for the foreseeable future in global oil markets, and that will keep prices high into the year end, in our view.
Francisco, last week we saw the U.S. Treasury Department basically flip-flop. On Wednesday, the Treasury Secretary said he will not renew the general license on Russian crude, and then Friday, very late at night, they decided to extend that waiver. How much is that cushioning the market right now?
Well, there is definitely a little bit of cushion. I mean, the Russian crude and product markets are pretty large. Russia is the world's depending on the day, second or third largest crude oil producer and the second largest petroleum product exporter. So that is a fair amount of cushion. But then again, remember, there's been reports of strikes in different Russian ports, both in the Baltic as well as, more importantly, in the Black Sea. We've seen impacts on Tuapse and Novorossiysk, and so. It's not easy for Russia to export oil either, because obviously we've seen news of Ukraine trying to attack those facilities. So, I mean, energy assets are just generally have become targets in military conflict, and that's one of the most difficult parts about forecasting where supply and demand are going to be, particularly supply, given that it's become very much right front and center of both policy action, to your point, on the U.S. Treasury decision, but also military action. And so I do think Russian flows are very important to keep the market in relative order. And that's why I think that decision was made at the end of last week.
Francisco, enjoyed the note. Thanks for carving out some time for us this morning. Appreciate it, sir. Francisco Blanch there of Bank of America. Some geopolitical gymnastics taking place in the Treasury over the past few weeks.
Yeah, within 48 hours. I mean, the Treasury Secretary had a press conference with Caroline Leavitt in the briefing room and said, we will not be extending these general license and these waivers. And then 48 hours later, they extended it. And Chris Wright, the Energy Secretary, was asked about this over the weekend, and he said there's just a groundswell of push from G20 countries, especially from Asia, that were like, we need your help. All this energy will already be going to China anyway. Please let it come to us.
Brent crude around 95 this morning. WTI in the high 80s, about 88.60. Let's give you an update on stories worldwide this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. Chinese President Xi Jinping says normal passage through the Strait of Hormuz should be maintained. In a call with the Saudi Crown Prince, Xi also said Beijing is advocating for an immediate and comprehensive ceasefire between the U.S. and Iran. A bipartisan group of senators reportedly warned United Airlines and American Airlines that a merger could hurt travelers. The Wall Street Journal reporting the lawmakers raised concerns about higher airfares and fewer flights. American Airlines said last week it is not interested in a merger. And Meta is planning to lay off around 10% of its global workforce in late May. Reuters is reporting the company is also planning further cuts in the second half of the year. The move could help offset some of its Meta's massive spending on AI infrastructure. That's your Bloomberg Brief, John.
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the program, confirming Kevin Warsh.
I think it's time to move on from the case and put our attention around getting Kevin Warsh confirmed by the United States Senate. Let President Trump have a new partner at the Fed. It's time.
That hearing at the Senate just a day away. A preview with Claudia Sahm of New Century Advisors. Up next from New York City, this is Bloomberg TV. Over at HSBC just publishing a great piece about the pushback as an equity market bull that he's getting right now. I'm sure these questions are very familiar. This doesn't make sense. Risk assets are detached from reality. The worst is still to come. We've all heard that kind of pushback over the past few weeks. This is his pushback, the counter-argument to the pushback. This is what he got to say this morning. Financial conditions have eased significantly in the last 3 weeks. At least so far, oil futures prices haven't converged higher to Middle East grades and dated prices, but rather the opposite has taken place. High-frequency U.S. consumption and aggregate growth proxies have accelerated since March, not fallen. And most importantly, the S&P 500 is not heavy in consumer cyclicals anyway. That's the bull case this Monday morning.
Yes, Max Kestner says that all of the pushback only makes him more bullish because when people say this time is different, he kind of laughs to himself thinking, oh, yeah. He also points to the fact that the rate of change for news is generally positive and the actual technicals look pretty good. So in short, be quick. These are the dips you want to buy.
The resilience of this equity market is anchored by, right now, some of the themes that Max Kestner was going through. And it speaks to this move here. Got a breakdown over the weekend and the diplomatic effort between the US and Iran. And the drawdown you see in the equity market, I don't even think you can call it a drawdown. We're down by 0.5% on the S&P, on the Nasdaq down by 0.5. Also, a bit of weakness there in the Russell. You anticipated that, I'm sure. In the commodity market, maybe we're looking for a bigger bounce in crude. 4 to 5%. Is that big? Probably not, given the moves we've seen recently. Brent crude at about 95. WTI around 89. Under surveillance this morning, a change of course. We're going to focus on the Federal Reserve, confirming Kevin Warsh.
It's time to move on from this. The petitions to the court have been rejected, and I think it's time to move on from the case and put our attention around getting Kevin Warsh confirmed by the United States Senate. Let President Trump have a new partner at the Fed. Let Treasury Secretary Bessent have a new partner in bank supervision and monetary policy. It's time, and I think it's important to move.
So here's the latest this morning. Kevin Warsh's confirmation hearing facing headwinds. Senator Thom Tillis still vowing to block the nomination until the DOJ ends its probe into the central bank. Joining us now is Claudia Sahm of New Century Advisors. Claudia, thanks for making some time for us today once again. Yeah. Ahead of an important hearing, I have to say, but are you anticipating more theatre than signal and insight in the next 24 hours?
Right, well, confirmation hearings always have an aspect of political theater to them. But this one, frankly, I think Kevin Warsh might almost be a sideshow at his own confirmation hearing. President Trump is going to loom very large in these hearings tomorrow and the pressure campaign he's put on the Fed. And we might learn not so much about Kevin Warsh and his views on monetary policy.
That said, Claudia, it feels like people are on tenterhooks waiting for him to give some signal of how high the bar is for him to cut rates and exactly what he plans to do with the balance sheet. Are you expecting no signal from him with respect to cutting rates at this moment, given the fact that Treasury Secretary Scott Bessent essentially gave him a green light to be a little more hawkish than perhaps President Trump would like?
Well, first of all, somebody's got to ask him about it. Right. Again, that's where I mean him not being part of the center of focus. If a lot of the questions are about President Trump and Fed independence and like that just wouldn't get to what's Kevin Warsh's reaction function? Like, how does he think about what the federal funds rate should be? What is he balancing? And it is difficult over his career it's a bit of an enigma what his reaction function is. So I think that's absolutely what we should be learning about tomorrow. I hope we get more guidance from him on this. But again, senators have got to ask him about it and really push him on how does he think about setting the federal funds rate. We might get some of that tomorrow, but I suspect we're not going to get as much as we really should be getting to kind of think about him as a candidate.
Claudia, are you surprised that the market's been relatively sanguine in the face of some real drama and real questions around A, who's going to be atop the Federal Reserve, and B, what will the composition look like given some of the drama with current Fed Chair Jay Powell?
So there has been absolutely nothing normal about this transition in leadership at the Fed. And again, that doesn't go back to Kevin Warsh. President Trump has chosen to run the vetting process in a certain way, being very clear that he's only putting someone in place that wants low interest rates like he does. The fact that we have an open criminal investigation against the current Fed chair that's holding up the confirmation vote. We have another governor whose job is before the Supreme Court because the president's trying to remove him. Like, nothing about this is normal. I mean, I think it will be good. There's a potential for Kevin Warsh to come in and kind of set the tone about how he's going to smooth out this leadership transition, because right now it's quite chaotic.
If Senators Jack Reed or Mark Warner or Cynthia Lummis are watching this morning, what would you ask them to ask Kevin Warsh?
So I think it's really important to help us understand how does Kevin Warsh think about rates policy? There's been a lot of times where he's talked about the balance sheet. We understand that he doesn't like the tool of the balance sheet. He wants a smaller balance sheet. One thing that I've been concerned about is often he said, well, as we shrink the balance sheet, that's going to give us space to lower interest rates. Okay, his agenda to shrink the Fed's balance sheet requires a real change to the framework. That is going to take a lot of time. Okay, say he doesn't get that. Is that what rate policy is tied to? Is him getting a smaller balance sheet? If not, what is it that rate policy is tied to? And how is he going to make these arguments? Because again, he's had very hawkish positions in the past, and now he has very dovish positions. And he's just trying to make sense of it. Like, what is his path? And I think for the Republican senators as well, they need to understand who is this person that they are elevating to Fed chair? How does he really process information about the economy? And there's a lot of question marks. A confirmation hearing is where question marks should get resolved.
Claudia, just a final question from us. In your opinion, what is the most convincing argument right now for lower interest rates?
Like right today, there isn't a convincing argument. There really is too much uncertainty about what's happening with the conflict in the Middle East. We still haven't had the tariff effects roll off. I think we can still build a case for the next move as a rate cut. I think that is still appropriate. I'd like to hear how Kevin Warsh builds that, because I would build that with some weakness in the labor market potential. That's not something we've ever heard from him per se on this. But there's a case for the next move as a rate cut, but it's really hard to say that should be happening right now and these should be big cuts. And that's where I think, if he wants to make that case, it would be really interesting to hear him make it.
Claudia, wonderful to hear from you. As always, Claudia Sahm there of New Century Advisors. I think we're all with Claudia right now, that we want this to be insightful. It will be box office regardless, but we want it to be insightful. Unfortunately, it risks not being very insightful at all.
I was thinking, can we send Claudia a costume to sneak into the hearings, to ask some questions that we actually want answered? Because ultimately it's going to be political theater, and all of us actually want the meat. So, Claudia, if you're looking for costume ideas, let us know.
Futures right now down by 0.5% on the S&P 500. Coming up next, we'll catch up with Michael Lehmann of Citizens, Henry Treyz of Veda Partners, Ellen Wald of the Atlantic Council, plus Vishal Khanduja of Morgan Stanley. The second hour of Bloomberg Surveillance up next.
We're caught in a tug of war between two profound and opposing forces.
The bombs aren't dropping and things are calming down.
Both sides don't want a deal that makes it look like, we lost.
We came into this with a pretty strong economy.
There is significant pressure on the global economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Pulling back from all-time highs on the S&P 500. The S&P on a 5-day winning run. The Nasdaq on a 13-day winning stretch. This morning down by just 0.5%. Here's the bouncing crude, WTI and Brent. The diplomatic effort breaking down over the weekend. The Strait still largely closed. Brent crude bouncing 5%. WTI up by 6%, but still trading south of 90 at 88.82.
And really what you can see right now is just resilience in terms of the market mood. And you can see that when it comes to U.S. equities. But you can also see that, to your point, with the bounce in crude. People expect this to be resolved, tied up by the end of May. And right now, that is thought to be a palatable outcome, at least for the United States and for U.S. companies that are heavily tech influenced. That said, should this be prolonged? How big is the downside, given the fact that people are not pricing in that tail risk?
There is what you might call an uneasy calm in this equity market going into the ceasefire deadline just a few days away. Will that ceasefire deadline be extended? It's self-imposed. Will we get an extension, or will hostilities resume?
I think everyone's looking for some clarity on whether or not even the talks take place tomorrow in Islamabad. You know, the White House is saying that J.D. Vance, along with Steve Witkoff and the president's son-in-law, Jared Kushner, are set to go. They would have to leave this evening from Washington to get there in time. We have not had official confirmation from Iran. And I talked to a Pakistani official that said it's true. There is still no official confirmation. Roule said, though, they wouldn't be making these plans if they didn't think those talks were going to happen. So potentially we'll see that. But we had a weekend where it wasn't just the Strait wasn't open. We had actual movement in terms of a U.S. Navy shooting at and boarding an Iranian vessel. We have not seen that since this crisis started and we had that blockade.
So on the calendar this week, and check it out, we've got possible, and I stress possible, talks between the U.S. and Iran ahead of that ceasefire deadline. We've also got this, and we need to talk about it some more. Kevin Warsh is finally getting a hearing down in Washington, D.C. Now, the Federal Reserve meeting is a week and a few days away, but increasingly the focus will be on a change of leadership. When that change of leadership happens, I don't know, and that's the elephant in the room coming up tomorrow.
Especially given that Tom Tillis, the senator, has said that he's going to block any confirmation. So, yes, this hearing might begin in the Senate Banking Committee. Can it be completed with a vote is going to be a key question. Ultimately, I keep going back to this hope that maybe Claudia Sahm can sneak into the actual hearings, because we want questions answered that will actually give us a sense of what his reaction function is, not political questions around, housing or whatever else.
Who would you like it to be disguised as? Pick a senator.
I'm actually thinking, I went there for a second in my head, then I was like, no, I'm not going to do there. So I decided, a sort of neutral, like a banker from like the 1920s.
Okay. That's the disguise.
That's the disguise.
Maybe Tina Smith, Cynthia Loomis.
Like a big hat, top hat.
Good save,
cane.
Bramo.
I know, maybe like a fake mustache.
Are you worried about upsetting Claudia if you pick the wrong senator?
Well, I just think that it would be, the whole point is I don't want it to be polarized. I don't want this to be a political point. I want this to be a markets-based point. So I'm going to just punch.
Unfortunately, that's tomorrow. It is a political event.
Correct.
Full of theatre.
Which we don't want, because ultimately we want to understand how high is the bar for him to cut rates and what does he want to do with the balance sheet. That's what I would like.
What did the president ask you, and have you committed to cutting interest rates? Are you loyal to the president?
Thank you.
How many times are they going to ask that in 25 different ways on the Democratic side?
Yeah, and it's going to be, I don't pre-commit to any kind of ongoing rate path, and I'm not going to disclose private conversations with the president on repeat.
No doubt there'll be a couple of senators asking about his personal wealth.
Exactly.
In which case he should have a list of everyone on the Senate Banking Committee and their net worth.
Exactly, and their
just
trades.
Respond one by one how much money they've made since they've been down in Washington, D.C.
Are you trying to telegraph this?
I'm just,
Here, cheat sheet
anyway,
for both sides.
I'm saying what I would do.
Okay.
All right, coming up, Mark Lehmann of Citizens Commercial Bank, his equities drift lower. Henrietta Treyz of Veda Partners as attacks in Hormuz complicate peace talks. And Wald of the Atlantic Council with crude spiking on the standoff in the Strait. We begin this hour with stocks holding near record highs following a tech-fueled rally. Mark Lehmann of Citizens Commercial Bank writing, AI demand is still the gravitational force in this market. Uncertainty hasn't disappeared, but confidence is rebuilding. Mark joins us now for more. Mark, welcome and good morning.
Thanks, Jonathan.
Confidence rebuilding in software as well. Software just had the best week in 25 years on the S&P 500. What's driving that rebound?
It starts with one of the worst 3 months they've ever had. That doesn't hurt, but obviously it was time for a bounce. I think the noise got too loud in terms of how bad it's going to be for software. Some of the CEOs have started to pick up the narrative that part of this may be a winners and losers, and some of the winners are going to do a lot better. Some of the losers, like all cycles, are going to have a tough time. The narrative for data centers has exploded in the last 3 weeks. You've seen some big offerings. You've seen some narratives. And I've been saying for a long time about what this time in our life cycle of the market is. Is this the late 90s? Is this, what period are we in? And I've been kind of honing in on this narrative. It is the late 90s, but it's the 1890s when we're building the railroads, and it's that big. And I think that narrative has come back to the markets, and that's what the market took advantage of.
Do you think there are enough good things happening in this sector now to ignore the bad things happening abroad?
The market thinks so. It also thinks it's going to be tempered, meaning it's going to be over by the end of May, like you just said. It's probably priced in too much optimism for that narrative. But on the other side of this, Jonathan, and I hate to be repetitive, it's that big. And I think what people pay for it is the bigger question, and how big it's going to be and who the winners and losers are. It's not a question of if, it's when.
Is the U.S. still winning the tech race? And I ask this because I was reading a Stanford paper over the weekend about how China is quickly catching up and really is neck and neck when it comes to a lot of AI capabilities. And you're seeing this in the performance of some of those companies. But from your vantage point, how real is that?
I think the U.S. is still ahead. I think the world is catching up. And when I say the world, is Asia. I think we haven't seen a lot elsewhere. But the U.S. is still ahead. It is really, and I hate the term given what's going on in the Middle East, it's an arms race, and it's a war for talent, and it's a war for speed. And the leaps are so fast. But yes, I think we're still leading, but I would not discount how much is going on in Asia. I've got friends who have visited there recently and have said this exact same thing. China and Hong Kong and a lot of places are catching up.
So there's an existential feeling behind this, which is the reason why all of the capital expenditures seem to be ongoing and accelerating, because ultimately no one wants to lose what does seem like it's fundamentally reshaping the way we understand work. That said, no company has come out and said this is a return on investment when it comes to AI. In fact, they can't even give a sense of when they will be able to materially monetize this. At what point will that disconnect start to really bite?
I think that's partially true. I mean, we're seeing that at Citizens, where we've got this reimagine the bank, and we've given use cases that have shown the kind of return internally that we see is justified. The big companies, the big AI players, with how much capital they're soaking up and how much capital they're spending, I think see that, and I think they do see the use cases. I'm a little less, I'm sanguine about that, Lisa. I think there is that kind of possibility for the companies, but we're in a moment in time where people are throwing resources as fast as they can, thinking that return will come. Not everybody will do that. But I think when you see the kind of returns that companies like ours are getting really rapidly, just in terms of call center optimization, just in terms of customer experience, just in terms of what our junior analysts are seeing when they're doing their work, there's that kind of productivity gains that we're seeing. We're seeing it, and it will allow a diminution in terms of the number of people. People are going to have to work harder and better and faster and smarter. But I think there will be that kind of return that we would hope we were going to get, and the AI companies are offering to everybody.
Meaning companies, maybe even yours, might have to lay off some people?
Well, I think it will be less so in terms of the layoffs and more so in terms of how many people do we need going forward. I think the nature of work has changed all the time. I say that constantly to myself and my kids. We all have to reinvent ourselves. AI is requiring people to reinvent themselves. The job that people are going to do is being reinvented. The resources they have are also going to be so much grander that it's going to make your job better. And for those who don't adapt, it's going to be really tough.
Given you said that this is so big, what's going on in the Middle East especially can't derail it, especially if it ends at the end of May. What if it doesn't? What if this goes on for months? Could anything really actually derail the story you're seeing right now?
Yeah, I mean, I don't think the AI narrative is going to get derailed. I don't think the data center narrative is going to get derailed. I think the cost of it, but they have the capital, right? There's an insatiable amount of capital that wants to play this. A, the people who've already done it. B, the people feel they missed it.
What about the capital from the Middle East coming in?
I think, listen, you're going to see probably some announcements from some of the expenditures the Middle East has made in terms of other forays that they probably have not seen that kind of return. I don't think they feel like this is one they want to avoid. I really don't. I think that's as high on the totem pole.
Mark, do you think the industry, the tech industry, needs a new PR firm? Because the PR right now that is coming from the leaders of OpenAI and Anthropic, whenever those guys speak, they seem to say the wrong things all the time.
It's funny. They've hired the best PR people in the world to work for them.
And yet they're getting it wrong.
And they are getting it wrong. Listen, it's really tough. I think this is a narrative. The masses out there feel like this is being thrown at them and they're not ready for it. I think if you talk to the electorate, and that's always the case with technology, Jonathan. It's going to happen. And people feel and fear it, and they want to go back because nostalgia is a wonderful thing. But you're right. I think the narrative is very difficult. They got the congressmen and women who don't want to hear what's coming. You got the electorate who fears it because of the jobs and what it's going to do to their lives. And then you got this overarching surveillance no pun intended, that they feel like is going to inhabit their lives. So it's a really tough putt, as we like to say.
The pushback is immense. And I understand why. When you have one leader coming out and saying intelligence is something you'll have to pay for. What? And then another leader coming out and saying that we're going to wipe out half of white-collar jobs. Again, what? And you're just going from one media outlet to the other saying the same thing. Are you hearing the kind of pushback you're getting, not just from Congress, but the pushback from the electorate as well? People don't want to hear that. They don't want to support companies that want to achieve those things.
Ultimately, if they want to raise money and they do want to IPO this year, maybe it's good for the roadshow that you can't have. If you don't have us, then you're going to be sunk. But it is terrible when it comes to convincing people that this is going to be a beneficial tool for their life to work better, because life is going to be harder for a lot of people. And frankly, there are going to be a lot of people who are displaced in the process. It is an uncomfortable message. They are not delivering it in perhaps the way that a lot of people would like. What is the right message right now, though? Because when you read these studies, it is a little petrifying when you know you've got to completely reshape who you are and what you're doing and how you work. And then you've got kids, and my goodness.
Mark, what do you think the right message is? What is the message that they should be driving home at the moment? Is there a good message to drive home?
It's such a good question. It's so hard to imagine when you repeat what Lisa just said and say, but this is going to be good for you.
Get on board.
Yeah, get on board because it's going to happen. I don't think that's the message. I think there's a real subtle shift that they have to make about how our lives and how it's going to improve your life is tough. Whether, I don't know if that's because your health care is going to be better. I don't know if you're going to be more productive. It's because it's going to make you a better citizen, a better parent. I don't really know, but what they're doing is not working.
Mark, appreciate your time. As always, it's good to see you. Thanks for being here. Thank you. Mark Lehmann there of Citizens Commercial Bank. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. The White House saying Vice President J.D. Vance is heading to Islamabad tonight to lead a second round of talks along with envoys Steve Witkoff and Jared Kushner, while the Iranians are denying they will participate in those talks with the U.S. A 14-day ceasefire is set to expire tomorrow. ExxonMobil, Chevron, and other energy companies are speeding up their searches for new oil and gas prospects away from the Middle East. The Wall Street Journal reporting they're exploring new drilling candidates in Africa, South America, and the Eastern Mediterranean. And in sports, the race for the Premier League title is neck and neck after Manchester City beats Arsenal 2-1. The two teams now sit just 3 points apart, with City having a game in hand. Erling Haaland scored his league-leading 23rd goal in the 65th minute for the win. That's Bloomberg Brief. John?
Yahara, thank you. Appreciate the update. Spurs. Mark, Spurs. Can you imagine Spurs getting relegated with that stadium?
It's not okay. It's too bad. But boy, the Premier League is on fire.
We're right down the brink of that happening. Very close to it.
Yeah, try being a Mets fan. I'm sorry. My sympathy.
How much worse is it as a Mets fan right now?
Yeah,
terrible.
0-11.
Isn't there the good news for you, there isn't another division beneath you for you to fall into.
No, but
just
it's
utter humiliation.
So you get to play Major League Baseball all the time.
It's depression. I mean, honestly, you relegate it and just end it already. It sort of put them out of their misery.
We got Spurs fans in our midst. It's not pleasant.
It's not pleasant.
It's not pleasant. No. I feel bad.
TK's a Spurs fan too.
Well, hopefully he's not a Mets fan too.
No, he's not.
He's a Red Sox fan.
Red Sox fan.
Yeah,
that's right.
So they're doing
Boston
okay.
sports. Anyway, up next on the programme, standing firm against Iran.
They wanted to close up the strait again, as they've been doing for years, and they can't blackmail us. We're taking a tough stand. They've gotten away with murder for 47 years. They're not getting away with it anymore.
Up next, we'll catch up with Henderson Treyz of Veda Partners, live from New York City this morning. Good morning. Stocks right now negative by 0.5% on the S&P. Similar move on the Nasdaq, pulling back on a Russell by 0.9, but incredibly robust over the past 3 weeks. 3 weeks of 3% plus gains on the S&P 500. That is very, very rare. On the Nasdaq 100 this morning, down by 0.5, but coming off the back of a 13-day winning streak. Big turnaround for the tech story. That's helped EM as well. Check out the MSCI EM stock index. We have erased the war gap lower. We filled the gap. Why? Because this index is not the economy. The number one weighting on that index is Taiwan Semi. Number 2 is Samsung. 3 is Tencent. 4 is SK Hynix. That's the big tech story driving EM stocks higher as well.
Yeah, with this belief that China and, frankly, Asian tech in general is catching up very quickly to the United States, with also a backdrop of potentially a weakening dollar. So once again, people saying that could take hold should this crisis abate, giving fuel to this ongoing trend that we've seen in the tech space.
That's the tech story. Let's turn to the commodity market moves. Brent and WTI higher this morning by 5 to 6%. WTI crude at 89. Brent crude around 95. Under surveillance this morning, standing firm against Iran.
We'll be talking about Iran later. We have very good conversations going on. It's working out very well. They got a little cute, as they have been doing for 47 years. Nobody ever took them on. We took them on. They wanted to close up the strait again, as they've been doing for years. And they can't blackmail us. We're taking a tough stand. They've gotten away with murder for 47 years. They're not getting away with it anymore.
So here's the latest this morning. The US seizing an Iranian ship near the Strait of Hormuz. Tehran vowing to respond with a fragile ceasefire set to expire in the coming days. Bloomberg's Tyler Kendall joins us now for more. Good morning, Tyler.
Hey, John, good morning. Well, there seems to be risk of escalation on multiple fronts, but still the White House maintains that diplomacy is still a viable option ahead of tomorrow's ceasefire deadline. But at the moment, Iran is wavering on whether or not it will send any diplomats to Pakistan for another round of peace talks. And at least for now, publicly, Iranian officials have denied making any concessions to the U.S. when it comes to their nuclear program. Plus, as you just mentioned, we really saw tensions flare in the Strait of Hormuz as Iran moved to reimpose restrictions on traffic, and the U.S. for the first time seized an Iranian tanker since the blockade began. Now, CENTCOM did put out a statement saying that this happened because the vessel failed to comply with military instructions over a 6-hour period. But despite all of this, President Trump still took to Truth Social and said that he sees a path forward for talks to progress, but importantly reiterated a threat to hit Iranian civilian infrastructure if a deal is not made in time. We're going to have to watch where this goes because the White House is pursuing that diplomatic route for now. The White House saying that Vice President J.D. Vance, alongside Special Envoy Steve Witkoff and the president's son-in-law Jared Kushner, are set to depart tonight for Islamabad. And, John, at this point, other countries are also ramping up the pressure. New this morning, Chinese President Xi Jinping saying in a phone call with the Saudi Crown Prince that it is imperative for the Strait of Hormuz to reopen. We should point out Bloomberg News reported last week that Gulf, Arab and European leaders are estimating it could take up to 6 months for a fuller-term deal to be reached as we tick closer to tomorrow's deadline.
It's Tyler Kendall down in Washington. Tyler, thank you. You can sense the fatigue. Another Monday morning that start on Sunday evening, waiting for that gap lower in risk and that bouncing crude off some tough words over the weekend, and then anticipating that any moment now, as we get closer and closer to the cash open stateside, you'll get a warm, fuzzy social media post about the prospect of talks and extending the ceasefire. That's been the rhythm, the pattern of things that this market has become exhausted and fatigued by over the past, let's call it 2 months now.
It feels like you're dealing with a friend who's a complete drama queen, and they keep coming to you with a crisis that they're going to resolve in a couple hours, and you stop paying attention to and stop caring about, and that's ultimately how the market seems to be responding.
I think it's the boy that cried wolf, right, when it comes to some of these proclamations, but actually tangible, nothing is changing at the moment on the ground. The idea, though, that this market has is at least they're talking or talking about talking. For the moment, seems to be good news.
Henrietta Treyz of Veda Partners writing the following: anticipating higher crude prices, understanding basic supply and demand realities can be undercut in an instant by a presidential tweet. Henrietta joins us now for more. Henrietta, welcome to the programme. Let's talk about those talks. Who is the US negotiating with? Who is in charge in Iran? And are they the same people?
That's the perfect question. I mean, I don't think that J.D. Vance is headed over there knowing exactly who's in charge. You can see disparate indications from across Iran, different directives, different statements about whether or not the Ayatollah is still being collected, whether or not you can use certain shipping lanes, who needs to turn around and when and why. The confusion is rampant. And I think the lack of a stable negotiating platform is really pointing to maybe at best, from the market's perspective, a continuation of the ceasefire, maybe for another 14 days, another couple weeks, but no clear definitive end to any of this.
I know you've done a lot of Hill checks. What are they saying about the ceasefire? Do they want to see that be extended?
It depends who you ask. So there is some indication from some of the members. I would say Lindsey Graham, for example, who's chairman of the Budget Committee, and we should watch him really closely because he's going to have a lot to say about how we provide additional funding for the Pentagon, or whether or not we stimulate the U.S. consumer to offset gas prices in the forthcoming budget reconciliation bill. He's been pretty aggressive behind the scenes, calling for the president to continue taking a very hard tact. But even the most concerned senators, I would say those who are up for election this cycle, are not pressing the president to just completely end this. If anything, they're more responsive to the president's tweets about, being Christ the healer and combative with the Pope. That stuff really doesn't play well with the American electorate. And so there's been a lot more opposition to that kind of dynamic than there has been to the decision now that it's been made to go into Iran. And now the strait is closed, and that's obviously a problem.
We're seeing in polling that Americans are frustrated with higher gasoline prices, but we're just over $4 a gallon on the national average. You say the line in the sand for Congress is $5 a gallon. Ahead of the midterm elections, if we hit $5, what's going to be the response?
There's two things at play here. So first, we've seen $4 gas before. We're at $4.08 or whatever right now. So the American consumer doesn't like this. It's not enjoyable, obviously, but it's not the worst thing they've ever seen. We've been through the Arab Spring. We've been through the pandemic. Staff on Capitol Hill really tells me that $5 is more the inflection point. As we get into the $4.50, $4.75, $4.85 range, we start talking about suspending the federal gas tax, which Canada has already done, and Georgia in the United States has already done. So there's room to run on that front. But really, for the election, it's the volatility. There have been some analyses done historically over how voters respond to higher gas prices, and it's not the price. It's the chaos. It's the extreme swings that voters don't like. That's what they pay attention to, and that's what Republicans have to worry about going into November.
Henrietta, what's your sense of the willingness to increase funding to the Defense Department going forward, especially should this start to spiral and the hot war begin to reassert itself?
There's definitely appetite for more defense spending amongst the Republican conference. I mean, there's no problem really with Lindsey Graham adding a $200 billion, maybe let's say $100 billion Pentagon plus up to their forthcoming reconciliation bill. It's shocking to me that they're only going to put a bill out that's maybe in the $75 billion range. This thing could be $700 billion if they wanted it to. The last time we passed a proactive fiscal stimulus bill, let alone under reconciliation, it was $3.5 trillion. So to get something with not even 3 digits is wild to me. I understand my perspective is biased since I deal with like hundreds of billions and trillions more normally than millions, but $75 billion is nothing. If they wanted to tack on additional funding for the Pentagon, they easily could and get this through the Republican conference. Democrats are not going to provide any votes for it. So if Hegseth needs money before, I don't know, a couple months from now, before September 30th, when the fiscal year ends, they're going to do it in this reconciliation bill.
Henrietta, good to see you, as always. Henrietta Treyz there of Veda Partners. Lockheed has sold off over the past 2 months or so, but year to date still higher by more than 20%.
This is one of the key trades for so many different investors. Go into defense spending because even Germany now, their sovereign wealth fund opening the doors to investing in these kinds of companies.
Up next on the programme, we'll catch up with Adam Wald of the Atlantic Council with tensions in the Strait of Hormuz sending crude higher. Plus, Danny has your morning movers. Senators reportedly warning United and American that a merger would hurt travellers. Last week, the biggest weekly gain since May on the S&P 500. Equities up for 5 consecutive days. Struggling to make it day 6. We're pulling back by 0.5%. Talked a lot about that 13-day winning run on the Nasdaq 100, the longest since 2013. On the Nasdaq 100, we're down by 0.5% this morning. Within the tech sector, software stocks just had their best week since 2001. That's a part of this equity market, a pocket of it, that's had some real pain for much of the year.
People were worried, especially with the private credit woes. We haven't said private credit in a while in redemptions, but that happened this year, too. And there was this fear that maybe people got over their skis with trying to predict their future revenues, given the fact that they could be disruptible. Now people are saying, who cares? They're so undervalued, we can go back in. And it just gives you a sense of how much of a relief rally we really have seen.
Nasdaq futures inching lower, even as talks over the weekend between the US and Iran. The diplomatic effort appears to be breaking down going into that ceasefire deadline. Brent and WTI are bouncing by 5 to 6%. WTI is still south of 90 at the front end of the futures curve at 89 on WTI crude. Back-to-back weekly losses for the first time since February. And this morning, I have to say, relative to the moves we've seen more recently, muted moves.
I think it's because the market is pretty much expecting the ceasefire either to be extended or actually the Iranians to show up to those talks tomorrow. We do know that the United States is preparing the delegation to leave as soon as this evening. They would have to leave to make those talks. We're just waiting on the Iranians to confirm that they are going to be there. And even if the talks break down, they decide they're not going to meet tomorrow, don't you expect the president to come out and say, I'm willing to give diplomacy a few more days? The issue, of course, is for the oil market is that not only is the Strait still shut, but this weekend, you had 2 ships in India that they were shooting at from the Iranians. You had the U.S. Navy fire upon and actually board an Iranian-flagged vessel. We haven't seen that since this blockade started. So the escalation we actually saw tick up this weekend, not wind down.
Brent crude at 95, WTI at 89. A few hours away from the cash open with your morning movers. Danny Berger has more. Hey, Danny.
Hey, John. Starting with some tech news, Marvell and Google reportedly, according to the information, reached an agreement in which Marvell would create custom AI chips, 2 different kinds of chips, but very specifically, they would only be for Alphabet. Alphabet shares a little bit lower in that agreement, but Marvell up 6.2%. Elsewhere, we learned over the weekend that American has said, no, thank you, United. We would not want to merge with you. This, of course, comes after reports that Scott Kirby from United went to the White House, went to this administration, said that he was interested in a merger of the two potentially. It would create, of course, one of the largest airlines, United and American, down at least 3% this morning. Finally, in other deal news, QXO, the Brad Jacobs company, will be buying TopBuild, a $17 billion agreement that would see the purchase price be about a $505 a share, so we're not quite at the deal price yet. Shares, though, are up about 18%. QXO, the acquirer, which, by the way, Brad Jacobs has been incredibly acquisitive over the past year. Those shares fall 4%. It would make QXO the largest building supply company listed. And, of course, this is an insulation company. And those are your movers. John.
Very cool. Thanks for the update. Danny, thank you. More from Danny in the next hour. On our radar this morning, the U.S. Navy seizing an Iranian cargo ship as Tehran closes the Strait of Hormuz once again. President Donald Trump threatening to strike Iran's power plants and bridges if a deal isn't reached before the ceasefire expires tomorrow. The UAE seeking a financial lifeline from the United States. The Wall Street Journal reporting Emirati officials are discussing a currency swap to protect their economy against potential impacts from the war. And finally, beginning today, businesses can claim refunds on the billions spent under President Trump's sweeping global tariffs. The Supreme Court striking them down in February, ruling the levies unconstitutional. Officials warning rebates could be months away.
So at 8 a.m., there is an online portal that people can submit their claims to. This is according to the U.S. Customs and Border Protection. And then the CBP will rule on said claims. It might take 60 to 90 days to get the rebate. Okay. We just all filed our taxes. We know how much we paid. I just wonder going forward what it's going to look like when suddenly you realize what the budget deficit looks like if they do give these refunds and then they put on additional tariffs. I mean, this sequence, I'm still trying to wrap my head around.
I want to know how much companies are paying to hire a team to do all this, because this is a baby step going on this portal and signing up. It's the first step to try to get the refund back. And there's going to be a few very annoying process underway to get these refunds back. And then to Lisa's point, this comes at a time when the administration says by this summer they want to get back to those same rates. So they're going to get a refund for last year, but then they're going to have to start paying tariffs yet once again after the administration goes through all the other avenues like 301s, 242s to get tariffs back in play.
We've introduced a lot of friction into the global economy in just 1 year. The trade story, the war in the Middle East. Can you imagine where the stock market would be if these two things hadn't happened?
I mean, honestly, this is what a lot of people talk about, that is putting such a damper. What we'd be talking about 10,000 on the S&P 500, not the Dow. I mean, we're talking about a market that has so many tailwinds that only is as high as it is at record highs because of how it's being held back by all of these other frictions. I think this is a side story. Question to me is, when does it become front and center once again when you start to see some of the additional tariffs put in place by this administration?
Certainly in the background right now, that's for sure. Front and centre is this story at the moment. Crude climbing on renewed uncertainty through the Strait of Hormuz. Wald of the Atlantic Council writing, instead of trying to jawbone markets with positive sentiment, the president should stick with messaging from a position of strength and no vacillation. Ellen joins us now for more. Ellen, welcome to the programme. I was speaking to a market contact earlier who had a basic question. Is the worst of it behind us? Is this the post-Liberation Day picture of the market right now? Is it a similar story, or is it different this time?
I'm not sure whether we're really whether the worst is past. I think that the U.S. actually commandeering or blockading these ships is pretty much an escalation of events. It depends, I guess, whether we see more active bombing and whether we see Iran responding to that by hitting its neighbors. I think that that's absolutely still in the cards, though the fact that the ceasefire is, I guess, technically still in place, though I'm not sure you can say it's still in place if we've had Iranian ships firing on ships trying to transit the strait and the U.S. firing on Iranian ships. I'm not sure we can really call that a ceasefire, but it does seem to still be in place. And so I wouldn't be too hesitant to say that the worst is past, but it could get worse very, very quickly.
Well, let me ask you what you think was more likely then in the next 24, 48 hours. An extension of the ceasefire or a resumption of hostilities?
I think an extension of the ceasefire is more likely, but only maybe a little over 50%, I would put it at.
So at this point, Ellen, how feasible do you see the outcome that the market is pricing in? This is sort of what we're trying to get our head around, because it seems like people come on this show who are in the equity space or who even trade oil, and they say, well, you know, this actually roughly games out what's probable. And then oil commodity strategists come on and they say, absolutely not. That seems highly unlikely. What's your take?
I think it's pretty unlikely right now. I think the market is over exuberant in terms of a fast fix to all of this. I think that despite what President Trump tweeted on Friday, Iran and the United States are leagues and leagues and worlds apart in terms of what they want. And Iran has absolutely no incentive to give in on anything at this point, because first of all, it doesn't see anything wrong with higher oil prices, whereas Trump keeps going back to these very positive statements to try to get prices down and get the Dow Jones up. And yet, I think it's pretty clear at this point that once everything actually is resolved, we're going to go back to where we were in a hurry. Oil prices will go down, equities will go up. And so it seems like it's a kind of confusing to me as to why he keeps trying to make things seem better than they are, just to get things looking better at the beginning of the week or when markets open, when, let it be. Say your position, hold strong, because that's clearly what he wants to do, and then let it all, let the cards fall where they will when it ends.
Ellen, you wrote the book on Saudi Arabia, Saudi Inc., talking about how the kingdom really came to fruition and some of the monetary backing of the oil complex. Do you have a sense of how much Saudi Arabia and the other Gulf countries are shifting alliances, moving away from the U.S. maybe amid this conflict?
I do think that we're in a different paradigm than we used to be. Really, Asia is the most important customer now for Saudi Arabia and the UAE and other big oil exporters. It used to be that the U.S. was their most important customer. However, China and Asian countries are not big military suppliers. China's Navy is never going to go into the Persian Gulf, whereas the U.S. Navy, they're the ones that are there. So it's a slightly different dynamic in that the U.S. is still very important financially, very important as a military supplier and as a naval force and an air force in the region, but it's not that, it doesn't play that same role as buyer of oil. And so that means that these countries have a bit less leverage over the U.S. than they used to.
But at the same time, they're not going to want to create all this friction with their security blanket, are they?
Exactly. And so it is a bit of a careful line that they're walking, because they need the military protection, but they can't necessarily say to the U.S., hey, we're going to we're going to control oil supplies now and to make sure we get that. It's not so much of a quid pro quo here. And I think that they do need to tread carefully, and we're seeing them tread carefully. They haven't been all that vocal about what's going on. And I think that's a sign that they know that their position is perhaps a little more precarious than it used to be.
Well, there were reports that Mohammed bin Salman had a phone call with Xi Jinping earlier today. Are the Gulf Arab partners, you think, pressing on China to put the thumb on the scale on Iran?
I think they absolutely could, because China is one partner of Iran that has that economic pull with Iran. On the other hand, I do think that these calls could be all about just maintaining maintaining the conversation about the fact that China has a lot of investments in Saudi Arabia that are not doing all that well right now because they can't get oil out, and there are issues with the petrochemicals. And so I wouldn't be surprised to see the Saudis and counterparts in the UAE reaching out to people in China to assure them that the relationship is strong, that once this is over, things are going to be repaired and go back to everyone making money the way it used to be.
Ellen, what happened on Friday? Can we just finish on that? Between 8 and 9 a.m. Eastern Time on Friday, there was a series of messages from one delegate coming out of Iran and another in the US, making the case that the Strait of Hormuz had reopened. And we were sitting here thinking, maybe it has. Let's see, let's wait and find out. And then we found out pretty quickly it hasn't at all. What happened there? Was it something the US did? Or was it just that the Iranians committed to something that ultimately not all Iranians and all interested parties had agreed to?
Yeah, I think it's both. It's a bit of both here, because there's a bit of over exuberance on the part of Trump to say the Strait of Hormuz is open, Iran has agreed to everything we want. Let's move on now. I think there's a huge amount of pressure, particularly from Trump, for that to be the message. On Iran's part, on the other hand, remember, these parties are not talking to each other. They're talking to intermediaries who are then talking to each other, who are then going and talking to the other parties. So Iran and the US are not communicating with each other. And so there's a bit of a dance in the wordplay that comes around. The US may say, we want X, Y, and Z. And when that message gets to the Iranians, it's not the same as exactly what the U.S. said. And so when Iran agrees to something, they're agreeing to what they think they're agreeing to, which can fly with their people, which is not necessarily what Trump thinks they're agreeing to. And this happens a lot in diplomacy, particularly when the parties are not actually sitting down at the same table as each other and not speaking the same languages. And so I think this means there's a lot more to bridge. Iran also needs to message to its own people. And as you mentioned on the program earlier, we're not entirely sure exactly who we're speaking to with regards to Iran. There's the IRGC and there's the elected government, and those are not necessarily the same and don't have the same opinion and don't even necessarily have the same elements under their control in the country.
Ellen Wald at the Atlantic Council. Ellen, thank you. It's a question we asked earlier this hour. We've asked it repeatedly. Who is the US negotiating with? Who is in charge in Iran right now? And are they the same person?
Yeah, and are they going to be communicating with the interloper that's going to then be talking to the other mediator that's then going to be talking to the other side? And this is the reason why it's a big game of telephone, but you're not even sure who's initiating the message. It's a very difficult scenario, and the reason why people are ending up with the confusion of the strait's open, it's closed, it's open, it's closed.
Which is why I think some investors just choosing to look through the whole debacle.
It just seems like something you can't game out or get an edge on, so analyze what you can.
Futures right now down by 0.5% on the S&P, just pulling back from all-time highs. With an update on stories elsewhere this morning, with your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. Tensions rising in the Middle East after the U.S. Navy boarded an Iranian-flagged ship in the Gulf of Oman. President Donald Trump also threatening to destroy every power plant and bridge in Iran if negotiations fail, as peace talks are expected to resume tomorrow. U.S. Energy Secretary Chris Wright saying gas prices may not dip back below $3 until next year.
I don't know. That could happen later this year. That might not happen till next year. But prices have likely peaked, and they'll start going down. Certainly with a resolution of this conflict, you'll see prices go down. Prices across the board on energy prices will go down.
The national average for a gallon of regular gasoline remains above $4, the highest since August 2022. And the Senate Banking Committee is set to hold a confirmation hearing for Fed Chair nominee Kevin Warsh tomorrow at 10 a.m. Eastern. Warsh's confirmation is in question, with Republican Senator Thom Tillis vowing to block any Fed nominations until the DOJ wraps up its current probe into Chair Jay Powell. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, pushing back on rate cuts.
The Fed has to get the rate down. I still think you'll get a couple of cuts. Do you push it back a little bit? Yeah, maybe. The 10-year part of the curve, it's pretty unbelievably stable.
Up next, we'll catch up with Vishal Khanduja of Morgan Stanley from New York City. You're watching Bloomberg TV. Futures slightly negative, pulling back from all-time highs that we posted going into the weekend on the S&P, the Nasdaq and the Russell. We're down by 0.4% on the S&P, underperforming on the Russell. Small caps down by 0.8%. Under surveillance this morning, pushing back on rate cuts.
The Fed has to get the rate down. I still think you'll get a couple of cuts. Do you push it back a little bit? Yeah, maybe. But you're talking about a very two-speed economy where interest rates really affects things. The 10-year part of the curve, it's pretty unbelievably stable. I do think when Kevin Warsh is confirmed, I do think you'll see a dynamic where can you contain the 10-year point of the curve.
So here's the latest this morning. Investors hedging against stubborn inflation, reversing rate cut bets as yields rise on the ongoing war in the Middle East. Vishal Khanduja of Morgan Stanley writing rates in the curve will adjust on a transitory inflation shock, not to a material or prolonged growth downturn. Vishal joins us now for more. Vishal, welcome to the programme. I was going through your note. A couple of lines jumped out to me. I just want to pick out one just to start. The perceived disconnect between rates and risk assets. You've highlighted that. What do you mean by it?
Yeah, good morning, John. Thanks for having me on. So very clearly, I think we have seen this massive disconnect, I think, since the first 2 weeks of the conflict, where you saw a massive repricing in the front end. Overall rates go up in countries or regions where we import a lot of that commodity. You've seen a much more, almost like a 10x standard deviation move on the other side. So the market is saying that the central banks need to step in. Instead of we pricing in cuts, now we have to price in 3 to 4 hikes to slow down growth and eventually then slow down inflation to avoid a pseudo 2022 type scenario. But the growth assets, risk assets on the other side, are completely ignoring the growth shock or the bumpiness from growth that we might get as central banks get less accommodative or more restrictive on that end. So that disconnect between the macro side of the market or the rates and much more liquid side of the markets presenting a scenario of significant inflation, which needs growth to be slowed down and then inflation coming down. And then the risk assets just ignoring all of that, saying economies are just fine. And even with that restriction, we'll be okay to price in much tighter spreads. So that disconnect is unwarranted in our opinion, and has to do a little bit with positioning of how we came into this conflict into March, and that's why it allowed us to reposition portfolios.
Vishal, not to take you too far away from fixed income, but do you think the cyclical tailwinds in the AI ecosystem go some way to explaining that performance in risk assets?
I agree. I think the two biggest parts, and I think if you just myopically just focus on the US, the two biggest growth drivers here, AI infrastructure spend, we are coming up with numbers 3.5 to 5.5 trillion over the next 24 months that the economy will see the boost from, is undeterred. And also the second part, which is the upper end of the K-shaped economy, consumer that is spending, again, undeterred with that $3.5 or $4 gas price that you've seen. So there is definitely a little bit more of that pointing to that fact that certain strong drivers of the economy are still almost undeterred through this conflict, but that does not apply directly to the global economy. That does not apply directly to economies that are going to be importing a lot of the oil and have seen energy shocks in the past as well.
It's a confusing moment, and it's a confusing moment in fixed income as well. And Vishal, it almost underscores how confusing it is that you're long the 7 to 10 year part of the yield curve at the same time that you're adding high yield bond risk. I mean, how do you understand exactly why we can both gain confidence in pinned inflation expectations over the longer term and invest in some of the riskier parts of the market that will benefit from an expansionary economy at a moment where inflation is higher than target?
Fantastic. Pinpoint there, and great question. I think high yield to us is, if you take a look at the 40-year spread chart for high yield, I think that spread chart makes a big assumption that today's quality of high yield market is similar to what it was in 2008, 2010, 2018, and so on and so forth. It makes a wrong assumption that the quality of the high yield market is not changed. But if you look through the details, it is the highest quality of high yield market that we've ever seen. Highest amount of double Bs, highest amount of secured bonds, lowest amount of duration that you've seen. So in fixed income terms, I think we are going after higher quality, higher fundamentals, higher yielding DXS type names or type allocation rather than actually buying a single A corporate on a 30-year or 40-year part, which is trading at 65 to 85 basis points over Treasury. So we think that the probability of excess returns in long spread duration bonds rather than short spreadier bonds is going to be very different, and the outcomes will be very different. But yes, security selection is significantly important as dispersion has picked up. I think a few of your guests talked about the software exposure, et cetera. That's just the tipping of the iceberg in our opinion. And then the other part about duration, I think we go back to that disconnect that we talked about, where you're seeing market pricing in quite a bit of that inflation shock. And just over the last probably 6 trading sessions, you start to come back and ask questions about the growth shock. And we believe that 7 to 10 year part of the interest rate curve here in the US, even if cuts are pushed back, even if the dovishness is pushed back through the Fed, whether it's the leadership change, whether it's a wait and watch approach, as the inflation prints will be coming higher, we don't think that the terminal rate has come any higher from our perspective. So that gives us that growth protection if we are wrong and we are growing into a much major growth correction. And then the high yield bit on the shorter side gives us that high quality yield bias within the portfolio.
Vishal, always smart and great to get your opinion on things, your insight. Vishal Khanduja there of Morgan Stanley. A fixed income conversation with no conversation whatsoever about Kevin Warsh and the hearing tomorrow, which I think tells you a lot about how fixed income investors are thinking about what's to come in that hearing.
It tends to be those kinds of events, though, that are the most market moving because people aren't prepared for it. Maybe someone dressed as the banker from, some movie in the 1920s might come in and say, what is your risk tolerance going forward? How high is your bar to cut rates? And then everyone will actually sit up and pay attention in markets, and it might be an actual tradable moment.
I think we want an understanding of the individual's reaction function and what kind of committee he thinks he's going to be coming into. These are the kind of questions that I think we've all got about this leadership. How have Kevin Warsh's thoughts evolved since we last heard from him? What are his reflections on the war in the Middle East, the future of Fed policy and communication, all of those things? How much insight we get on those things tomorrow? My bar for expectations is pretty low.
I think a lot of people's are, which is the reason why they're focusing on other things.
Coming up tomorrow, Stephen Parker, or rather up next, we'll catch up with Stephen Parker of JPMorgan Private Bank, Sadek Wahba of I-Squared Capital, Isabel Mateos Lago of BNP Paribas, and Mike Contopoulos of Janus Henderson. That hearing, of course, is tomorrow. The third hour of Bloomberg Surveillance is up next.
The market wants to be positive.
This is a market that is ready to rip.
We are long the equity market. I'm comfortable with the way the market's behaving.
Heightened geopolitical risk, but also bullish markets. That is the prevailing mood right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now. Your equity market looks like this, pulling back from all-time highs on the S&P. We're down by 0.4% following a 5-day winning streak into the weekend on the Nasdaq. You've heard about this a million times already this morning, I'm sure. 13-day winning run on the Nasdaq 100, pulling back just a touch. We take some weight off that recent rally. We're down by 0.4%. In the commodity market, an update on Brent and WTI crude. Some tension over the weekend between the US and Iran. Brent bouncing by 5%, WTI up by close to 6, 88 and 94 respectively.
I have great sympathy and respect for people trying to trade this oil market right now. Good luck, because ultimately it has been such a whipsaw, and it's the reason why markets are not paying as much attention. Initially, when the war in Iran started, you saw a real lockstep between equities and oil prices. Increasingly, people seem to be shrugging off some of the gyrations, focusing instead on earnings. And this comes with a slew of corporate earnings and the fact that ultimately the backbone of the U.S. economy still seems like it's very strong.
On the earnings front, you'll hear from United Airlines later this week, Tesla, IBM next week. The major tech firms all reporting around Wednesday, so look out for that. The only thing you can do is go to the calendar. Coming up tomorrow, potentially, talks between the US and Iran, approaching that ceasefire deadline.
Potentially, and Wolf Research, Tobin Marcus, who's a friend of the show, just put out a note talking about everyone wants a deal, but at what price? Even if the worst is behind us, we're back to two-sided risk. So potentially we're going to have those talks, or potentially we're not. And then what does that mean? Does the president offer a diplomatic roadmap, off-ramp of a little bit more time going past the April 22nd deadline? Or are we back to more escalation, which we did see this weekend in the Strait of Hormuz?
It's so difficult to predict those things, so what have you done? You've bought tech. So many people have been piling into the tech trade. We just had the biggest week of gains for software stocks since 2001. For the Nasdaq 100, the longest winning streak since 2013. And next week, earnings from Amazon, Microsoft, Meta, Alphabet, all coming up potentially on Wednesday.
Yeah, people have been focused on just how much cash they're earning and the fact that they've been derated in terms of multiple expansion, just simply because they have not kept pace with the rally earlier this year. Going forward, the key question is how much tolerance is there in the market for an ongoing acceleration of capital expenditures, given the fact that this is an existential race. That's going to be put to test next week. The fact that we're just speaking with a fixed income strategist who doesn't like investment grade debt as much gives you a sense of potential pushback, not necessarily on people not willing to buy the debt, but potentially offering, demanding a significantly higher premium for it to be sold.
A small dip this Monday morning in equities, at least. We're down by 0.4%. Coming up this hour, we'll catch up with Stephen Parker of JPMorgan Private Bank with a record-breaking rally on pause. Sadek Wahba of I-Squared Capital on how the war in Iran is intensifying the need for infrastructure. And Isabel Mateos Lago of BNP Paribas previewing tomorrow's confirmation hearing for Kevin Warsh. We begin this hour with stocks falling and crude rising. Stephen Parker of JPMorgan Private Bank writing, uncertainty remains elevated and downside risks related to higher energy prices must still be considered. Stephen joins us now for more. Stephen, good morning.
Good morning.
How are you framing this for clients? Do you see it as a sustained supply problem or a transient shock?
We think that it's, we're always careful about the word transient after the last couple of years,
course.
right? But I think that our base case is that oil prices are likely headed back to something like $75 to $80 a barrel over the next 3 to 6 months.
What informs that base case?
Our view is that we think that ultimately, while we're not trying to predict geopolitics, we look like we're headed towards an off-ramp solution to this conflict. We do think that supply, particularly here in the U.S., is well supported. And ultimately, we think that we're going to see a resumption of global oil supply in the near term.
So do you choose to ignore the incoming headlines as they whipsaw investors in one direction and the other?
Well, I think what you have to recognize is that markets are becoming a lot less responsive to these headlines, right? This type of move in energy prices a month ago would have caused a lot more of a reaction to equity markets than the 40 or 50 basis points that were down this morning. And I think that reflects a little bit of, one, an assumption that we are headed towards a lower oil price environment, but two, a shift in focus, as Lisa said, to the earnings story, which remains very well supported.
And this idea that we already had multiple compression from the big tech space as they didn't keep up with some of the rallies since later last year. So there's a question here of how much of that catch-up trade already has been priced in and how much more there is potentially to go.
Yeah, I mean, the sell-off that we saw earlier this year was all sentiment-driven. It was all valuations because earnings revisions were actually moving higher. So the biggest concern that markets have had over the last couple of years, which was elevated valuations, concentration within the tech sector, as you said, now all of a sudden those valuations are a lot more compelling. Add on top of that what we think is going to be another double-digit quarter, another double-digit year for earnings growth, both this year and next year. That's a well-supported environment for equities.
What are you expecting to hear, and how do you expect markets to respond to some of the big tech players coming out saying they're expanding their spending plans dramatically, that much more because all the inputting commodities are increasing in cost?
Right.
At a time when people are already feeling like we're kind of getting to a place where you guys are looking a little bit like telecoms?
Well, it was interesting because last year, anybody who made an announcement related to AI capital spending saw a boom in their stock right away. That was the great stories what everyone wanted to focus on. Towards the end of last year and early into this year, particularly as you started seeing these hyperscalers turn to debt markets became a little bit more selective in terms of their response to some of these capital spending stories. I think that's likely to continue, but the good news is with earnings revisions moving up, valuations coming down, perhaps the bar, even after the rally in the last couple of weeks, is a bit more manageable in terms of how markets are going to react to some of this spending announcement.
Stephen, when it comes back to the war and how markets are dealing with that, you say the U.S. is not fully immune to what is going on. Yeah. It does feel like we are a little bit less vulnerable to the rest of the world. At what point do you think the U.S. really would start to feel the brunt?
You know, when we do a scenario analysis, and this is one of the things that we put out in our recent publication, you know, our base case is that $75 to $80 range. But we also look at a world in which oil stays here around $100 a barrel, or even perhaps spikes to 140. In the current sort of $100 level, you take a little bit of a hit to growth, you see a little bit of a spike in inflation. That's a bit of a challenging environment for both stocks and bonds. But from an economic perspective, it's something we think you can manage through. If you see a further spike, call it $120, $140 a barrel, then all of a sudden what is a kind of modest growth environment for now to the end of the year turns into something that looks more like potentially a mild recession.
But would that hurt the AI trade?
I don't think it will hurt the AI trade as much. I mean, when you look at the parts of the economy that are most vulnerable to the higher energy prices, it's the consumer, it's particularly the lower end consumer. I don't think the momentum that you're seeing in the tech story is going to be derailed by higher energy prices.
Have you got high hopes for some insight in the hearing tomorrow with Kevin Warsh?
No, I mean, I think that you're going to see some grandstanding. You're going to see some push to resolve the outstanding investigations. I think what's going to be more interesting is listening to what he has to say about the view on the Fed and the balance sheet. Are we going to see potentially quantitative tightening as a way to enter the story around lower rates? But I don't think we're going to see a lot of fireworks.
Do you think that's something that's needed?
No. Our view is that right now we're sort of in a spot where the Fed probably should remain on hold. Our view coming into the year was one cut. The move higher in energy prices means that inflation becomes a bit more of a concern. But we actually think you're seeing some signs of stabilization in the labor market, and that allows the Fed just to kind of sit and watch for a little while.
One big feature of the rally that we've seen in risk assets has been utter stability in the rate side of the picture. And ultimately, this kind of pairs with the idea of these hearings. At what point can that not last, given the fact that we have drama that's almost unprecedented in terms of the race for the next Fed chair and, frankly, the composition of the board?
No, the interesting thing is the rates have been rather steady in the longer end of the curve. Shorter-term rates have actually moved a lot, right? And one of the things that we've been watching is the shift in expectations, not just for the Fed, where markets went from 2 to 3 cuts this year to on hold. And if you look at other central banks around the world, they're actually pricing in meaningful hikes over the back half of this year. That's where we're finding some more tactical opportunities within the rates market, getting clients to think about moving out of cash into short duration, either treasuries or investment grade debt, given that repricing.
At what point do you think that higher commodity prices paired with relatively resilient growth in the United States will lead to a creeping higher in long-term inflation expectations, especially if it seems like a Kevin Warsh Fed, should that occur, and as it will likely occur, is inclined to cut rates and is inclined to have a more accommodative policy? Yeah, so we haven't seen it yet, right? If you look at the inflation expectations, both in terms of what the market is pricing as well as survey data, the view is that this is a short-term move and not a longer-term move. The longer we stay at potentially $100 plus in oil, the more you're going to start thinking about whether or not this is going to turn into a longer-term question. We're not there yet.
Stephen, it's good to see you. As always, thanks for dropping by. Stephen Parker there of JPMorgan Private Bank. I remember the days when people were uncomfortable with the prospect of this going on for months and not weeks, and it looks like it's going into month 2, maybe month 3. People are relieved that betting markets now have a little bit more than a 60% chance of this resolving at the end of May. I mean, we're in April right now, if I do remember correctly, and if I'm actually getting my date correct, but it feels like the bar has shifted, and the real cannibalization in the physical market is making some people very concerned, while people in the market say, but look at tech. I lost track of this year at some point in Q1. Because Q1 felt like a decade. Yeah. And then I've got no idea where we are from there. And every week right now just feels like one very long trading day that starts on a Sunday and ends on a Friday, then starts again on a Sunday and ends on a Friday. I'm getting that feeling, though, from our guests as well. I'm just saying this. I don't want to put words in their mouths, but it feels like everyone is up late on a Sunday night, coming in on Monday saying, oh, my goodness, we've got to do this again. It is a fatigue moment. The fatigue is real, that's for sure. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. The White House saying Vice President J.D. Vance is heading to Islamabad tonight to lead a second round of talks, along with envoys Steve Witkoff and Jared Kushner. The Iranians are denying they will participate in those talks with the U.S. A 14-day ceasefire is set to expire tomorrow night. The Senate Banking Committee holding a confirmation hearing for Fed Chair nominee Kevin Warsh tomorrow at 10 a.m. Eastern. Warsh's confirmation has been in doubt, with Republican Senator Thom Tillis vowing to block any Fed nominations until the DOJ wraps up its probe into Jay Powell. And New York City Mayor Zohran Mamdani saying his plan to charge an annual surcharge on uber-wealthy owners of second homes is an important step in his pledge to raise taxes on the wealthy. Mamdani is framing the tax drive as a way to increase affordability and improve services for average New Yorkers. That's your Bloomberg Brief. John.
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next, the morning calls. Plus, we'll catch up with Wahba of I2 Capital on how the war in Iran is intensifying the need for infrastructure. Live from New York City this morning. Good morning.
You went from being deeply underweight just a couple weeks ago to very rapidly back up to neutral. And that kind of buying power has really been the fuel for why we've seen markets move up so far so fast. I think some of that is now behind us, which means we're far more sensitive to incoming news, meaning we need good news in the Middle East in order for this to continue.
That was Cameron Dawson of NewEdge Wealth. No sign of good news over the weekend. Equities pulling back from all-time highs, but only a little bit. On the S&P 500, negative by 0.5. On the Nasdaq 100, down by 0.4. For the Nasdaq Composite, this from Jim Reed of Deutsche Bank. 13-day winning run. Only 4 longer streaks have occurred in the index's 55-year history. That's how unique this run has been.
Yeah, and this latest 13-day run for the Nasdaq Composite, the longest going back to 1992, at a time when people are saying this is a steal, that actually valuations have come in to such a degree that this is a screaming cheap buy, even though a lot of people are raising concerns about sort of the irrationality of risk on, given the fact that we're dealing with potentially a real stalemate.
The Nasdaq 100 right now, this morning at least, negative by just 0.4%. That's the price action. Let's get you some morning calls. First up, KeyBank raising its price target on Alphabet, calling its cloud momentum underappreciated. Your second call from Bank of America raising its target on Amazon, expecting first quarter revenue to exceed expectations. And your third and final call from the team at Stifel, raising its target on AMD, noting strong compute demand. Turning back to our top story, the war in Iran. President Donald Trump threatening to, quote, knock out every single power plant and every single bridge in Iran if a deal is not reached. While the war weighs on global infrastructure, Wahba of I2 Capital is remaining positive on the sector, writing, quote, the fundamental need for infrastructure in this part of the world doesn't disappear because the environment is difficult. If anything, it intensifies. Sordek joins us now for more. Good morning, sir. It's good to see you.
Thank you.
Thank you very much for being here. So in your opinion, in your mind, the war of the last 2 months or so doesn't upend infrastructure. It might accelerate it.
Unfortunately, in that sense, yes. So 2 things. First, you're going to get at least $60 billion, probably more, in terms of direct infrastructure damage. The problem is that's the physical damage, but you have consequences in addition to that, meaning it will take you a couple of years to rebuild some of that infrastructure. You'll have to spend on defense. So overall, the governments of the GCC have probably another $100 billion that they need to spend over the coming years. What that will do, in my view, is it will push these governments into investing in these projects through direct government intervention and national oil companies, but then let the private sector focus on the remaining infrastructure over the course of the coming decade. If you look at the share, for example, in Saudi, of non-government oil, that's about 40%. What's that number in the US? About 15%. So that share of government expenditure needs to come down anyway over the coming years, and that, I think, will be accelerated because of what has happened.
What do you think the key priorities will be now?
I think there are 2 key priorities. One is redundancies, and the other one is accelerated growth. So redundancies, because we've seen that there's too much concentration in particular areas. So, for example, 20% of the oil goes through the Strait of Hormuz, 20% of the LNG goes through the Strait of Hormuz. So what the GCC countries will need to do is to create redundancies, more pipelines, more storage facilities. And you're talking, by the way, they're already talking about that, right? It's not something that is speculative. What kind of pipeline do we need to build to remove that reliance on the Strait of Hormuz? What kind of storage facilities do we need to put in? So you're going to get a huge boost in investment in that kind of infrastructure to reduce that reliance. So that's one aspect. The second aspect of it is
if you look at the non-energy infrastructure, a lot of it has been concentrated in particular geographic areas. So, for example, take data centers. One of the highest penetrations, by the way, of mobile phones. Fantastic. But the digital infrastructure is highly concentrated in a few hubs. So, few hubs, global cloud dependency, fiber optic comes in particular geographic areas, which we don't need to mention, so all concentrated in those areas. So that will have to change over the coming years. So one is data center. Another one is water resources. 67% of the population in the GCC relies exclusively on desal water. And all the desal plants are along that coast, which is in the Gulf of Persia. So you'll need to create a new infrastructure for water reserves that need to be put in.
This is a lot of money, and it's even more money when you think about how much the commodity prices are increasing as a result of all of this infrastructure build. Where is the money going to come from? Is it going to be diverted from other initiatives that these Middle East countries are now investing in, whether it's golf or whether it's the Premier League in football? Or is it going to be coming from outside investors?
I think it will come primarily from outside investors. So take a private equity firm like I Squared Capital. We're looking to deploy easily over $2 billion in the coming years in the region, in that kind of infrastructure. It could be in water resources, data centers, which are already doing, renewables. Renewables penetration in that area is 5 to 7%. US is 20%. World overall, globally, it's about 30%. Europe is 60%. So they're way behind in terms of integrating renewables power into their system. So I think you're going to get a lot of investments. It should come primarily from foreign direct investments, private capital, and that's already happened in the last couple of years.
Do you get the sense that there is an allegiance in terms of where the money comes from to go into some of these projects, the infrastructure projects? And I say this at a time where it seems like the world is kind of fracturing, and there's a real question about U.S. money going into the region, or is it Asian money that's going into the region, at a time when this used to be sort of the new financial capital that's kind of been called into question. I mean, do you have a sense of where the flows are going to be coming from?
I think, interestingly, the flows are going to continue to come from the U.S., because we are the largest, deepest capital markets in the world. There's no doubt about that. We tend to be sometimes short-term and forget about the long-term. Asia tends to be more longer-term. But you have a huge base of private equity investors in the US that is looking to invest in the region and will continue to invest in the region and are willing to take a longer-term view. I don't think that was the case 10 years ago, because you've seen fundamental changes in the region, notwithstanding the war. But Asia capital, your point, I think is going to be very aggressive, like it has been in Latin America, like it's been in Europe, through Belt and Road, through other mechanisms that China has developed. Absolutely.
Sometimes there's a habit to talk about the region as a monolith, but it's not. Who's hit the hardest right now? Is it Bahrain and Kuwait? Are they going to need the most money?
The truth is, the people think of these as different countries, which of course they are, but they all rely on that energy infrastructure, which has been hit. That, I think, will need to be rebuilt very quickly. Some of it will take years, as I said, because I'll give you an example. Today, I want to build in the US a power plant. We have huge needs for power plants, right? Because of data centers. For me to order a turbine from Siemens, Mitsubishi, GE, 5 to 7 years. So think about that region where they have to rebuild. It's not as much as the cost, it's as much as the time that's going by. So they will have to wait quite a bit to be able to rebuild that. So it's honestly across all of the energy sector. What has been most hit is, of course, anything that has to do with the US. So US bases, where US activities occurred, that was hit.
What about the trillions of dollars these countries have pledged to invest into the United States after the president made that huge foreign policy trip last year?
Yes, I was actually part of that trip with President Trump. I think those investments will happen, but maybe will happen over a longer period of time than expected. Let's put it that way.
That's what I heard. I heard all those investments are now getting kicked down the road. Just kick the can. But for the President of the United States, this was a huge foreign policy win.
Yes. You see, there's an irony to that. I think those economies are willing to invest in the US. The question is, in what sector? And are we able, do we have the mechanism to take on those investments? So it's easy to invest in the stock market. It's much more difficult to invest in a multi-billion-dollar pipeline that needs to be built. So ironically, it's the availability of projects in the US that is the challenge. The permitting, the regulatory frameworks, all that is effectively slowing down the ability to absorb that kind of capital.
Lisa tries to ask the question, do you think the Saudis will stick with Live Golf? Have you got an opinion on that, sir?
None, but I think they will stick, yes.
So I appreciate your time. Thank you, sir. Thank you
Not
very
at all.
much. So Wahba there of I Squared Capital. You went there. I didn't go there. You went there.
I know. I did.
Okay.
I was like sort of, alluding to this because it's sort of some of the places that money has gone. And I know that you're kind of hoping one way or another in that particular area.
I don't think they stick with Live Golf. I think they wait until after the next tournament wraps up because it's going to be at Trump National in Washington, D.C.
Okay, there we go. Getting some headlines from Kevin Hassett, the NEC director. He's reflecting on that Wall Street Journal piece about a swap line for the UAE. Kevin Hassett calling the UAE a valuable ally, the best and would help if needed, but ultimately a UAE FX swap line probably won't be necessary.
Yeah, this is going to be a delicate dance as some of the relationships in the Middle East are fought for. I mean, the idea that Asia right now, in particular China, is being really aggressive in the region highlights the need for extreme diplomacy and the desire among some countries to be courted.
Well, swap lines usually happen through the Federal Reserve, and there's traditional ones like Canada, Japan, the UK. But last year, the Treasury Secretary did a swap line through Treasury, and it was through Argentina. So if we were to see one, it would probably be Besant, similar to what we saw in Argentina. But I also agree with Kevin Hassett. I don't really think the UAE needs one.
That's the latest from Kevin Hassett, the NEC director, speaking to the press just moments ago. Coming up on this programme, we'll catch up with Isabel Mateos Lago of BNP Paribas, looking ahead to tomorrow's confirmation hearing with the Fed, potentially the next Fed chair, Kevin Warsh. That conversation just around the corner. From New York City, you're watching Bloomberg TV. The opening bound is about 60 minutes away. A record-breaking run of this equity market on the S&P. 5 days of gains on the S&P 500, 13 on the Nasdaq 100. This is the very, very small pullback this morning relative to a major bounce over the last 2 or 3 weeks. On the S&P, 3 consecutive weeks of 3% plus gains on the S&P 500. We're declining by just 0.4% following a weekend full of chaos and confusion.
Yeah, if you just woke up after being in a coma and suddenly you look at the fact that the U.S. was going and physically attacking a ship and boarding it that was Iranian and that the strait's now closed and there are questions around whether the talks will actually take place tomorrow, you'd think that oil would be up much more. You would think that stocks would be down much more. But at the same time, people have gotten used to this. This is our Sunday night drama. And so people say, OK, we kind of have gotten the story. This is going to get resolved one way or another. We're moving on. How do you get an edge at a time in an untradeable market in terms of headlines? You focus on something else, and that is right now what the market is doing.
And it definitely feels like this market is really holding on to the idea that the ceasefire that either will be extended or those peace talks, the second round, will actually happen tomorrow in Islamabad. Right now, the White House is planning to send the Vice President, Steve Witkoff, and Jared Kushner. But we have not had clarity or confirmation on the Iranian side. So potentially we could see some serious escalation in the next 24 hours, but the market at the moment doesn't really seem to be pricing that in.
Like Lisa said, we've seen this movie before. Another Monday morning that started on Sunday evening and a Monday morning full of fatigue and exhaustion.
And so people are just saying, look, you've done this every single night. I feel like it's like a parent talking to a young kid. It's like, you said this every night. You're not going to go to school the next morning. You're going to go to school. And so at a certain point, people just sort of move on. This does feel slightly different because the physical world is being disrupted. And ultimately, at what point do we start to see that in the data? We're going to be getting some ISM data later this week, the PMI data, rather, not the ISM data, coming out. Do we get a sense of a slowdown in business sentiment, in particular in certain regions as a result?
If my football team lost, I did ask for the day off. That's what I'd ask for.
Really?
Yes, if the team lost. Yeah.
Okay, but that was like consistent, right?
Sometimes it was granted.
But your team did. Your team did lose
Really?
this year.
Well, I'm not 10 anymore.
Sorry.
So I'm not getting days off.
Yeah, I hope my kids aren't listening. Please don't listen to that. You're absolutely not getting the day off if the Mets lose, because the Mets lose every single time.
Then they get
You know the
day
last
off.
time the
Perfect.
Yankees lost what the Mets are dealing with right now, 10 games, was 1913.
Oh, rub it in.
Embarrassing.
Where'd you find that stat?
Someone on Twitter
That's
posted
quite a
it.
step.
And DraftKings. And then I did my own research, and it's accurate.
Okay.
I'm leaving.
Stay with us, Brammer. 28 more minutes to go. As we count you down to the opening bell, let's get you some single names, some morning movers. Danny Berger has more. Hey, Danny.
Hey, John, some deal news this morning. USA Rare Earths is going to be buying a Brazilian mining company called Salsa Verde for $2.8 billion. Shares of USA Rare Earths now up 8.5%, which is usually rare for the acquirer, but it just shows a lot of these American mineral and rare earth companies are looking to try to build up their stockpiles and a lesser reliance on China. Elsewhere, a satellite company, AST Space Mobile, they had a satellite that was aboard a Blue Origin rocket that was launched over the weekend. It was supposed to enter an orbit, but something went wrong. It basically detached from the rocket, but didn't enter the right orbit. In other words, this satellite was lost. It's going to come back down into the Earth. It's going to burn up in the atmosphere. So those shares down 13%. Finally, another little bit of deal news is coming from the information that Marvell will be building two distinct TPUs for Alphabet. One will be to accompany their own. Another one will be a separate one to run AI functions. Either way, it's just going to be purpose-built for Google. So those shares up 5 3/4%. Google slightly lower this morning. John.
Hey, Danny, thank you. Thanks for the update. More from Danny alongside Matt Miller in about 25 minutes' time. Let's go to the calendar. Tomorrow, Kevin Warsh set to face Capitol Hill investors. They're listening for any clues on where the Fed chair nominee stands on interest rates. Mike McKee has a preview now, and he joins us for more. Good morning, Mike.
Good morning, John. Well, it's important to recognize this is just a step along the way for Kevin Warsh because Senator Tillis is still determined not to vote one way or another until the administration drops the probe into Jay Powell and the Fed's remodeling. So it has some interest for the markets, but it's not going to tell us much about where we end up. Now, the questions for Warsh, the first and most important one, who does he work for? Does he work for the president and do what the president wants about interest rates? He will say no. But the question is how he will say no. Then if he's still interested in rate cuts, though, when and how much? That's going to be a major topic for people in the markets who think that the Fed is going to be cutting rates by the end of the year. The balance sheet, how small does he want it to be? Will they sell off mortgage bonds? He's suggested that they might want to do that. That could be very complicated. Also, does he want to go back to scarce reserves? And then communications. He thinks the Fed talks too much, and it would be better if, especially the Fed bank presidents, didn't speak as much about what their forecasts are because he doesn't believe in the idea of forward guidance working very well. We also have, as you were just talking about, some important economic data this week, also coming tomorrow, the biggest numbers of the week, retail sales. Are Americans hanging in there? We're going to see a big jump in retail sales because of gasoline prices, retail sales denominated in dollars. So it may or may not tell us a whole lot. There isn't much else this week. Thursday jobless claims, but those PMIs that Lisa was talking about will give us some indication of where we are because they are April data, preliminary data. So it'll be interesting to see. The forecasts are that they go up a little bit. And then we'll be looking at Michigan sentiment on Friday. And of course, that's the inflation expectations number that everybody's been watching all week long, the Fed blackout. So we won't have any Fed comment except for this. Tomorrow afternoon, Chris Wallace is speaking about how he sees the Fed changing in the future. And that will be sort of at the same time as Kevin Warsh. So maybe we'll have dueling views of the Fed's outlook going forward.
So, Mike, how does Chris Waller do that, the governor of the Federal Reserve? Does he ignore current monetary policy and just focus on communication and those kind of things?
Yes. He can't talk about monetary policy, but maybe he's talking about bank regulation. Maybe he's talking about communications policy. He could even be talking about the balance sheet and scarce reserves versus ample reserves, just as long as he doesn't talk about interest rates.
There we go. Mike, thank you. Thanks for breaking it down. Mike McKee there with a preview of everything coming from the Federal Reserve. You mentioned the PMIs. You're right, too. Soft data has been OK. In fact, in many cases, better than OK.
Yeah, the global PMIs are going to be really interesting for April because we might see that things are OK in the United States. But if you're talking about jet fuel potentially running out in Europe in 5 weeks, things are not OK. And flights already getting canceled. Does that start to show up some of that data in those PMIs?
Let's build on some of these themes. Isabel Mateos Lago of BNP Paribas writing the following. Markets will be on the lookout for hints of Warsh's policy reaction, as well as elaboration of his plans for Fed reform. But it's possible we get little on either topic, given given all of the other issues in the air, I'm pleased to say that Isabel joins us in the studio. Isabel, good morning. Good to see you.
Good morning.
What's the best we can hope for tomorrow in that hearing?
Oh, the best we can hope for is a standard grilling about, what does Kevin Warsh mean by we need regime change at the Fed? How should the Fed respond to this stagflationary shock? And what does he have in mind for the balance sheet?
And what do you expect?
Well, I expect there will be other issues creating some noise, but I think it would be, this Senate confirmation process is a very important part of the process for getting it right at the Fed, and I'm sure a lot of senators, in fact, most senators involved, will want to make sure that they go through the full due process, and I'm sure Kevin Warsh himself, for his own sake, will want to address these policy issues rather than the political noise around this.
Right now, even some of the more dovish Fed members have expressed hesitation from cutting rates anytime soon, given the inflationary shock. There had been discussions about even rate hikes not so long ago. Do you think that the prospect of central bankers acting overly hawkish in the face of this oil price shock, that sort of faded away a bit in terms of likelihood, both in the U.S. as well as in Europe?
Yeah, so one thing that struck me out of all the pronouncements made at the IMF spring meetings last week by central bankers is how humble, in a way, they all were in accepting that we don't know where this is going, this being the situation in the Gulf and therefore the situation with energy prices, and we don't know how the economy will react. Therefore, let's really wait and see and not rush into action. So I think whereas initially there was a fear, and you saw this in market pricing, that certainly Bank of England, ECB might go in a very hawkish direction, I think they've pulled this back. And the Fed, interestingly, has gone a little bit in the other direction. I mean, obviously, the FOMC members who were hawkish to begin with, like Austin Goolsbee, have stayed hawkish. But very interesting, I thought, the speech by Governor Waller, where he set out that, look, this is not just another supply shock. This is one in a succession of supply shocks, and we need to be cautious. So I really saw a combination of patience and vigilance, and that seems to me exactly right. And we have to see how events pan out in the Gulf.
It does seem a little bit like we're dancing on the head of a pin.
Yep.
Because on one hand, growth and just the acceleration that you're seeing from corporations seems to be holding in. At the same time, the commodity prices are fundamentally and structurally potentially higher going forward. And yet people are expecting inflation to go back to where it is without necessarily the hikes from central bankers around the world that they previously had been thinking about. So can you square this circle with a peg in the middle?
So, no, I can't. But what's really interesting is, again, when you talk to central bankers and like, okay, we have our models, and the models, probably suggest that there will be some degree of second round effects. On the other hand, we have no faith in our elasticities in our model. And this is not 2022. The economy is not overheating to begin with. Monetary policy is not overly accommodative. So we're in a different place. And let's see how this pans out. Having said all that, I think it's very clear there's a lot of resilience in the economy. And an economy that's resilient may well end up generating more second-round effects that you would like, or that central banks would be comfortable ignoring. So I think they're going to try to wait and see as long as possible. But the minute we start to see some pass-through, some inflection in wage setting, so the PMIs are going to be important for the extent to which we see an impact on activity. I'm not sure we're going to see much of a slowdown yet. But also the extent to which you see a pass-through from input prices to output prices. We didn't see that in the March PMIs. Let's see what happens this time. I think that's going to be really important.
How much more insulated is the Federal Reserve to deal with this than, say, the European Central Bank?
Well, it's not insulated. I mean, if anything...
well, we're a net energy exporter. That's what I mean.
Yeah, but that doesn't help deal with the energy, with the inflation angle. It helps cushion the shock on growth. Maybe that's also an issue for debate, because, frankly, the entire economy, the entire set of consumers are being hit now. And yes, being a net energy exporter might help if you start seeing more investment in energy production, and you're beginning to see that, but the timelines are not the same. But the inflation shock is exactly similar. Now, Fed rate is either moderately restrictive or kind of around neutral. So again, this gives them time to wait and see. But the labor market is in balance, and the economy is not weak by any stretch of the imagination. So I think the Fed has to be cautious, and that's what we heard from Governor Waller and others last week.
Oh, looking forward to hearing from Mr. Warsh himself tomorrow in that hearing. Isabel, good to see you. Thanks for being here. Thank you very much. Isabel Mateos Lago there of BNP Paribas. Let's get you an update on stories worldwide this morning with your Bloomberg brief. I'm pleased to say Yahara's with us for more. Hey, Yahara.
Hi, John. President Donald Trump renewing his threat to attack civilian infrastructure in Iran. In a Truth Social post, the president vowing to, quote, knock out every single power plant and every single bridge if Tehran does not accept a U.S. deal. Meta is planning to lay off around 10% of its global workforce in late May. Reuters is reporting the company is also planning further cuts in the second half of the year. The move could help Meta offset some of its massive spending on AI infrastructure. And in sports, the NBA playoffs are underway with the Orlando Magic upsetting the Detroit Pistons in Game 1. The top overall seed, Oklahoma City Thunder, beating the Phoenix Suns, while the Boston Celtics taking down the Philadelphia 76ers. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you for this morning. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with Mike Contopoulos of Janus Henderson, with investors looking at stocks falling slightly and pulling back from all-time highs. Going into the opening bell, about 47 minutes away. From New York City this morning, good morning. You're watching Bloomberg TV.
I think the noise got too loud in terms of how bad it's going to be for software. I've been kind of honing in on this narrative. It is the late 90s, but it's the 1890s when we're building the railroads, and it's that big. And I think that narrative has come back to the markets, and that's what the market took advantage of.
That was Mark Lehmann there of Citizens Commercial Bank weighing in on a pretty epic rally for tech stocks. We've talked about the software sector a few times this morning. The best week since 2001. Microsoft with the best week in a decade plus. Some big moves going into earnings next week. Equity futures this morning erasing the losses as we get closer and closer to the cash open. Bramo, we're down just 1/3 of 1% now on the S&P.
It seems like in overnight trading, things are, oh no, maybe this is something we should react to. And then as the morning gets closer to the U.S. Open, people say, but what about the tech names? Because they're doing great and so is everybody else. It seems like everyone is looking to what they can analyze, and that has been earnings coming out of all of the big companies. And frankly, we're seeing IPOs announced. Jersey Mike's actually filed confidentially for an IPO. We're seeing mergers and acquisitions. We're seeing high-yield bond deals getting announced. This is the capital markets that really just doesn't want to hear more about the Strait of Hormuz.
Deals and agreements getting done. Adobe teaming up with Microsoft, Anthropic, OpenAI, Nvidia. That just crossed in from the Wall Street Journal. All these kind of things. That story continues.
Yeah, there's plenty of money out there, and their capital markets are wide open, and that enthusiasm for a technological revolution right now is triumphing over the what-ifs, as you do see the physical markets brought to a complete halt with this crucial waterway completely shuttered right now.
Adobe in the pre-market higher by some 4%. As we count down to the opening bell, a few things to look out for over the coming days. Tomorrow, US-Iran talks could be on the schedule. They're possible. Let's see if they actually happen or not. Also, a Kevin Warsh hearing in front of the Senate Banking Committee taking place tomorrow. So look out for that too. As we work our way through the week, we'll get some earnings and some data. Retail sales data coming up as well. United numbers too, plus results from Tesla and IBM. You're pretty focused on the airlines, aren't you, for the week?
To me, they are the key economic indicator, the real-time sense of just what the physical shortages are, as well as just how much consumers are willing to pay up for prices, given the fact that they have to compensate for the higher gasoline prices. How devoted are you to go to the south of Italy for summer?
Very.
And who cares?
But not this year.
Okay, good luck.
But if you get stuck there, the issue isn't getting there. It's Europe.
I'm not too bothered about getting stuck there, to be honest with you. You know, pretty committed to that. You know? Anyway, but not this year. We'll talk about that another time, all right? Let's talk about corporate earnings boosting sentiment. The outlook for earnings pretty solid. S&P 500 companies reporting so far have seen profits come in 11% above expectations. Mike Contopoulos of Janus Henderson writing the following. Earnings continue to be strong globally, reinforcing that before the war, the economy was in a good place. Mike joins us now for more. Mike, good morning.
Good morning.
Congratulations as well on the
Thank
recent
you.
combination. It's good to see you under the Janus Henderson tent now. Let's talk about the outlook. Is the outlook for earnings still good following this war?
So far, yeah. So far, the outlook does look pretty good. I mean, we haven't really seen yet any sort of collapse in earnings expectations. You know, estimate revision ratios still remain reasonably strong. And this isn't just a U.S. phenomenon. It's a global phenomenon. I mean, emerging markets continues to look good from an earnings perspective for now. Listen, we don't have enough data yet to know what's going to happen in Q2 and Q3 and beyond. And I think much of that will depend on how long oil prices stay high for and how that affects margins and ultimately consumption. But we came into the Iranian war in a really, really healthy spot. And I think that's what we're starting to see as earnings are rolling in for Q1.
When we say the outlook for earnings are good, are we talking about a handful of companies? You mentioned EM. You go through the list of EM equities in the MSCI index, and it's just Samsung, Taiwan Semi, SK Hynix, Tencent, Alibaba. Is it more than just tech?
We just named like 6 or 7 companies, but...
which make up probably a quarter of the index.
They do. I mean, obviously, there's huge concentration in Taiwan, South Korea, and even in the China, markets. But, yeah, I mean, you're starting to see a bit of a broadening. And I would argue that, although higher oil prices may hurt emerging markets and nat gas prices and higher oil prices, European companies, of course, commodity-oriented companies in emerging markets should do quite well in this environment. I think will ultimately prove to do pretty well over the longer term. Yeah, but there's a broadening, and broadening just doesn't mean outside of U.S. tech. It does mean globally, even if it means technology globally, with, again, South Korea and Taiwan being kind of 2 of the key drivers there on the tech side. But yeah, there's a broadening. There's a broadening happening across markets.
Yeah, it's a broadening based on growth and based on this commodity cycle that we seem to be facing off with. And I'm going to trigger a bunch of people out there, but it kind of draws into question 60-40 composition, given the fact that ultimately you're going to be dealing with an inflationary push coming from the commodity side of things. Do you think right now certain equities are a better hedge than just full faith and credit government bonds?
So not because of any sort of default risk or anything on the U.S. government bond side, but certainly as inflation goes up, you're going to have higher interest rates. And I do think that we're going to be in an environment where it's going to be difficult outside of a recession to get below 4% on the 10-year and stay there. And in fact, the longer, stronger growth in inflation remains, I think you're probably going to trend more towards 5%. In that world, energy and industrials, value, dividend-paying companies are all going to perform quite well. They'll do well in an environment where, duration is getting hurt. But it doesn't mean you have to avoid fixed income. I think it just means that you have to change how you invest in fixed income. So you have to own more floating rate debt. You have to own shorter duration. So think like securitized products, CLOs. Think floating rate treasuries or short duration corporates. Things of those natures. I think that's going to do quite well in that environment.
So this is actually a really interesting point that we were speaking with Morgan Stanley about earlier, this idea that high yield might look okay, actually much better than investment grade as a haven play, because investment grade is also pegged to duration as well as, it just doesn't offer the same kind of cushion against that inflationary risk. Do you agree with that?
So theoretically, that sounds great. Certainly if all you cared about was the duration side, I'd say sure. But the path to hell is paved with carry in credit. And you got basically no carry in corporates at the moment. And so why bother with high yield at 250 to 350 over? Let's just make a big range there because that's kind of where it's been over the last several months. When I can go and buy mortgages, I can buy AAA CLOs, I can buy longer duration munis, which I know has the longer duration aspect to it, but in a balanced portfolio where the overall duration is low, at least you're picking up some spread and yield there as well.
Tomorrow we'll spend a lot of time on Kevin Warsh's hearing on Capitol Hill. How relevant is this Fed to your outlook at the moment?
So, we try to navigate the noise, so to speak, and not pay too much attention to what's going on politically, which I view part of this theater as being somewhat political. At the end of the day, it depends on what the committee is going to do, not what Warsh is going to do. And if the Fed cuts interest rates in an environment where inflation is probably trending towards 4% and growth is reasonably strong, you're going to see significantly higher interest rates, and it's going to defeat the purpose of what the administration ultimately wants. The bond vigilantes will come out. It'll start to punish the bond market. You'll see huge selling, and that's when you get to 5%. If the Fed keeps rates where it is, or even hikes, which I think is entirely a possibility as we get later into this year and into 2027, that's when actually you slow growth and inflation. That's when rates fall. So it flips sort of the argument on its head, and it seems like that the administration is missing that point, but I don't think the Federal Reserve will miss that point.
You dropped a bomb at the end there. You think it's possible later this year?
Oh, yeah, for sure. I mean, listen, if let's say oil were to settle in that 70 to 80 range, something like that, and not slow growth too much, but contribute to inflation, and earnings growth remains robust, and the economy kind of hums along, absolutely, why not?
Mike, it's good to see you.
It's great to see you as well.
Thanks for dropping by. Mike Contopoulos there of Janus Henderson Investors on the potential for a rate hike later this year.
Yeah, this is something that other economists have pointed out as well. The idea that the worst case scenario for the Fed is $80 to $100 a barrel, because that wouldn't slow growth so much that you would have sort of the natural tamping down of inflation, but you would have those inputs that would be increasing at a time where we still have not gotten down to 2% for more than 5 years. I mean, I just keep going back to that. Where we're starting is also in a more inflationary moment.
It's hard to communicate this to many a politician, but if you want lower interest rates, don't push for lower interest rates is usually the best way of getting lower interest rates.
Doesn't work. That's not a good pundit talking point. And honestly, on Instagram, that really just wouldn't fly, John.
You know?
He uses truth on Instagram.
They want to clip those little videos.
Yeah, exactly. We're not going to be like,
I get
if
it.
you want to hike, you lower rates. It doesn't really work.
Coming up tomorrow, Chris Ferrone of Strategas, Andrew Sheets of Morgan Stanley, Savita Subramaniam of Bank of America, and Dana Peterson at the Conference Board. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.